Right, good morning to our wonderful audience, and thank you for joining our Offshore Manager webinar today. It is great to have you all with us, and we thank you for your continued contribution. We have a fantastic lineup of 10 leading investment minds for you today, mainly covering global equity markets while taking a deeper dive into developed market equities, emerging markets, outlook on China, as well as global credit. Even though the session will be very fast-paced today with limited time, you are welcome to post questions in the Q&A box, and we will endeavor to cover those questions as best we can, time allowing. Those questions that stand over, we'll try to address via email afterwards. Thus far in 2023, there's been significant macroeconomic shifts and dislocations in sector and regional performance. Despite compelling valuations, beginning of 2023, with wounds still fresh from 2022, most clients and managers were cautiously positioned. Then fast forward 7 months, global equity general funds in ZAR did on average 21%, and things like global credit more or less 15%. Yes, Rand weakness did aid in some of those numbers, but year to date, if you look at the Magnificent Seven, as I'll refer to of late, shares like the likes of NVIDIA up 190% in USD, Meta up 140%, and even mega caps like Apple and Microsoft up 40 to 50%. Seems as if we are in a late cycle where bears capitulate, and some may feel that we are missing out with the fear of a looming recession still there. US equities relative to US bonds looks super expensive, and I think one should question the risk reward. Where is this elusive recession we were all warned against? Why is this dragging out? Is it because of the US consumers' excess savings? About a year ago at the peak, it was roughly about $2 trillion US, which subsequently dropped below $500 billion US. And you can already see this in some of the retail sales numbers coming out of the USA. Or is it maybe fiscal policy driving the economy in the US fighting the Fed? Despite the much anticipated impact of the Chinese economy unlocking end of last year, Chinese equities were among the worst performing shares for the first half of this year, but did benefit somewhat from improving sentiment in July. Chinese equities are some of the cheapest equities in the world, trading roughly at about 35% discount to the global benchmark. But China's corporate sector is facing a confidence crisis. What can we realistically expect from China, and how will this impact on global markets and even places like SA? This brings me to our guest speaker of today, all the way from Montreal, Yang Wang, Chief Emerging Markets and China Strategist at Alpine Macro. And prior to joining Alpine Macro in January 2018, Jan spent more than 15 years at the bank credit analyst as Chief China Strategist, and is thus truly an expert. Jan, it's truly a privilege to have you join us today, and thank you for your time, and a very early good morning to you where you are. We really appreciate you getting up so early and speaking to our audience.
Great. Thank you, Eugene. Thank you very much for the very kind introduction. It's a real pleasure to be here to participate to this event. The topic of my presentation is, you can see this is China outlook and EM global implications. So with that, I want to address 3 issues. So first is China still investable? The first issue. The second issue is, how do we see Chinese growth in the near term? And the third question is, what are the global and EM implications. So the slide here, so this slide here kind of summarizes my key points, and I will come back to this slide repeatedly during my presentation to guide the discussion. So the first question is China still investable? So I think my answer to this is yes. Of course, there are a lot of problems, a lot of issues, a lot of question marks, but I just do not feel it's realistic for global businesses and global investors to avoid China. So for that, I have three reasons. The first reason is China is still a major global growth driver. The second is China has this very unique competitiveness advantage, which means that growth will likely remain superior to global average. So the competitiveness is China is both very tech savvy, but also has much lower cost than developed countries. And the third reason is overall, Eugene, also you mentioned, Chinese stocks valuations are deeply depressed. So from a long-term point of view, there is opportunity for long-term mean reversion. So let's go through these 3 points with some charts here. So the first chart I want to show is on the left-hand side of this page. So this chart shows over the next 5 years, China is expected to account for over 20% of global growth. This is almost as high as the US and India combined. US and India are the second and third largest drivers for the next couple of years, but China is almost as large as both countries combined. So obviously this is according to IMF estimate, which may or may not happen. But one thing for sure is that Chinese economy will remain critical for global growth, for global businesses. So we hear a lot of talks about decoupling, nearshoring, friendshoring, trying to bring manufacturing capacity away from China to other countries, including countries like India, Vietnam, Mexico. This is obviously is happening, but we also need to put these in the proper perspective. If you look at on the right-hand side of this chart, Chinese manufacturing sector is by far the largest in the world. China is the largest, and then US, Japan, Germany are the second, the third, and fourth. But from the chart, we can see here, Chinese manufacturing output is almost as large as US, Japan, and Germany combined, right? So, if we really think about some smaller countries, Chinese manufacturing GDP is 10 times that of India, 20 times that of Mexico, and 85 times that of Vietnam, right? So, obviously you can see the sheer scale of the Chinese manufacturing business is just too big to ignore. So, nearshoring, friendshoring, all these things may be happening, but, they are marginal. And first of all, and second of all, it will take a very long time to have a kind of a visible impact to damage Chinese manufacturing sector. So this is the first point. The second point is, we talked about Chinese competitiveness advantage. So on this page here, the red line, you can see this is Chinese exports global market share. We can see it has increased substantially over the past 2-3 decades. But if you look at what China has been exporting, right? So within the Chinese export sector, we can see a clear trend that is the share of low value added products has been shrinking, right? So products like textile, clothing, shoes, all these kind of stuff, they have been shrinking, they have been falling, replaced by electronics, machinery, and then in the past year or so, automobile. Actually, China just surpassed Japan to become the largest car exporter in the world. I wouldn't have been able to imagine this to happen so quickly, even let's say 5 years ago. So I think the competitiveness of Chinese manufacturing sector is actually pretty formidable. And I think one reason for this increasing competitiveness is China has become increasingly tech heavy. And one chart we can show on this chart is on the you can on the right hand side of this page. You can see this is the you can see China, the robot installation has increased massively. Actually, we can see Chinese robot, industrial robots installations account for over 50% of the world total in the past year. And so-called robot density, right? So this index measures the number of robots per employee. So robot density, we can see the bottom panel here, has surpassed that of the US and Japan, Taiwan, and is approaching South Korea and Germany. So which I think it's quite remarkable given the massive size of the Chinese manufacturing sector. So the manufacturing sector not only huge, but also it's a lot more tech savvy than many people expect. So another chart we can make this point is this chart. So this chart plots a country's so-called innovation index against its income level, right? So in this chart, we can see a clear trend, which is a very clear kind of positive correlation between a country's income level and its level of innovation. You know, most countries follow this rule, but you know, obviously China is an outlier. In the ranking of global innovation, China ranks at number 11 among all these countries. But we can see Chinese income level is a lot lower than countries at similar innovation level. So I think this is a key reason behind China's competitiveness. And I don't think this can be easily challenged by other countries. And the third reason, you mentioned, I completely agree. So, you know, if you look at Chinese asset prices are clearly cheap by all measures. Chinese stocks are probably among the cheapest in the world at this moment. You know, obviously, valuation is not a good timing tool, but I do not believe this kind of valuation gap between the US and China will last forever. So this is kind of my basic view for the first question. To recap, I believe China will remain one of the most important growth engines for the global economy. Global businesses will still see China as a very important growth driver. This unique competitiveness advantage cannot be easily challenged. And the large valuation gap is subject to long-term mean reversion. So over the long run, I still think it's a very attractive play. So that's the first question. Let's move on to the second question of my presentation, the cyclical part, which actually I'm less positive. So my key view is that the cyclical headwinds on the Chinese economy will persist. You know, policymakers are responding, but they are very they have not been very effective. So here summarizes my key points. So the Chinese economy did improve significantly after zero COVID policy were removed at the end of last year, but all the recovery signposts that we've been following have all faltered. You know, policymakers are ramping up easing measures, but these measures are too vague and too broad, not aggressive, not decisive enough. So my view is that unless Beijing really steps up ahead of the curve, the economy will continue to face downward pressure. So let's use some charts to see these points. So on this page, page 8 on the left-hand side, so this chart shows our nowcast model for Chinese GDP. You know, clearly the last data point, in the last 2 data points, growth has rolled over. I think for the whole year, GDP growth may still be able to achieve like 4 or 5%. It's still possible, but that's primarily because last year we had such a low base. Clearly, the economy, the economic recovery has disappointed. So there are a few key signposts that we've been following. To monitor China's post-COVID growth recovery, and all of them, all the 4 signposts have faltered. So on the left-hand side here, this is the consumer confidence. On the right-hand side, this is business confidence and investment intention. Obviously, we had a brief rebound and then fought back. It's very similar in all other charts that we are showing here. And this is the third one is credit impulse. We had a brief rebound and then fell back. And then the last one is the housing market. Housing transaction improved pretty significantly at the beginning of the year, but then in the past couple of months, couple of weeks, just fall back to very low levels, even lower than 2022. So all these charts are telling us that we had a notable rebound since after late last year, but most of the gains have been given back. All the improvement have been has faltered. So Chinese policymakers are obviously aware of these problems, and they're stepping up easing measures. Even this week they cut interest rate, right? So I think they cut rate on Tuesday, following very weak number they announced in July. But so far these measures are too broad and too vague. For example, if we can just list a few policies that they announced in the past couple of 2-3 weeks. They announced a 31-point plan to support private economy, a 20-point plan to support consumer spending, a 26-point plan to ease visa and hukou rules, and 24 plan, which is announced last Friday to attract foreign investment. Obviously they are very important policies, very important, addressing some very important concerns about the Chinese economy, but these measures are so broad. It's very difficult for people to quantify the impact. I don't even know if the government officials know how to evaluate these measures. And it's also really difficult to tell what policies are the government's priorities, right? So you can't just announce 100 points plans without emphasizing on certain things. So I think as an investor, for me, there's no way to quantify whether these measures are effective, and there's no way to evaluate whether these policies will be effective. So I think these are just, I believe these measures may work on margin, but Beijing needs to be a lot more aggressive, a lot more decisive, similar to what they did after the global financial crisis. They announced a big bang type of investment plan. They put a floor under consumer confidence and business confidence. And I'm not sure Beijing is ready to do that. So I think that's my basic concern. I think the economy is still struggling, but Beijing is aware of this growth problem, but they are not aggressive enough. So I'm afraid that Chinese growth conditions will not improve much. And if things do not improve much, given how weak the confidence has become, the downward pressure on the economy will just intensify further. So I think overall Chinese growth may not look terrible compared with last year, but this sequential growth will likely continue to disappoint. So this is my second question of my presentation. I'll skip a few slides, and then the last question is, what does all this mean for EM and global? So here are my key points. So clearly the Chinese stocks are depressed, but there's no clear catalyst for a positive re-rating. I think we need some kind of very clear policy action to backstop the growth deterioration, to backstop consumer confidence for the deterioration. I don't see a clear catalyst that is happening. And especially, I do not really have a good sense in terms of timing. That's the first point. The second point is, overall, we expect EM assets will face some near-term volatility due to Chinese growth problem. And also, we see rising risk of a US recession. We have been positive throughout, and then we just turned slightly cautious last month, I believe, because we see both risk factors. Chinese growth will likely continue to disappoint, and then we are seeing rising risk of US recession. And obviously EM assets are very growth sensitive. If both US and China do not perform well, it's difficult to expect other EM countries will do well. Given time constraints, I don't want to expand on this point. And the last point if we expect volatility in EM, so the implication is that we like bonds more than stocks, and we like LATAM more than Asia. So, so for bonds over equities, the reason is very straightforward. So the reason is, if you look at here, most EM countries, inflation has been falling very quickly. EM easing cycle has begun. On this chart on the left-hand side, top panel shows a very broad EM disinflation process, and central banks have already begun to cut. Right, so we had China, Vietnam before, and then more recently we have Brazil and Chile, and more likely Mexico, Colombia likely will join. So interest rates in many EM countries will continue to fall, and we like LATAM bonds the most because their central banks have tightened the most. So interest rates in these countries should have more room to come down. I think that's the key reason. And for equities, we also like LATAM more than Asia. If you look at on the right-hand side chart here, this chart, LATAM has outperformed Asia since 2022, actually quite a bit. But it's primarily driven by stronger earnings, right? So if you look at earnings, actually outperformed more than stock prices. So if you look at the bottom panel here, LATAM forward P is about 30% below Asia. And if we believe LATAM central banks continue to cut rates, their equity multiples should begin to expand. So their stock prices should continue to outperform. So I think that's the time that I have. I'm happy to answer any questions that you may have.
Yeah, and thank you very much for that. Indeed, not a very positive story, I think, in the very short term. I don't see any questions from the audience, but maybe from my side. I mean, you alluded to that as well. I mean, most economies saw a nice good boom after COVID, and many thought we would see that boom coming from China as you unlocked in November 22. But like I said, and you illustrated that as well, it's been far more sluggish. And more so, I believe, in the month of July, you've actually seen a decline in consumer prices, speaking to deflation. And it seems like it's struggling to revive demand. Yes, you showed that exports increased, and it looks attractive. Prices are certainly very attractive. But with global growth likely to slow even more, and you also alluded to, the mention of a rising risk of a US recession. Do you think that demand will remain sluggish for the rest of 2023? And yes, you say there's no clear indicator of a catalyst that will revive or see a re-rating in prices. What can we expect for the rest of the year?
I think overall growth will. If we expect overall growth to accelerate from here, Chinese policymakers need to do a lot more. I think they need to cut interest rates aggressively. They need to really use their central bank, use the central government to expand their balance sheets to really pop up aggregate demand. I think that's the key policy. The policies so far they are moving towards that direction. But the policies they are announcing so far are trying to change the business environment, which is important. But there's no quick impact from all those policies. They need a big bang type of like investment deal, for example, to build infrastructure, similar to what they did in 2008. After that, the Chinese economy immediately bottomed. So that actually put an end to the global financial crisis. So I think China is reluctant to do that again. They were hoping that the piecemeal type of stimulus could support the economy, and the economy did improve, but then it just deteriorated back. So it means that the economy needs a lot more support. I was just in China last month. I stayed in China for about 6-7 weeks. So that's my kind of my way of understanding what's happening on the ground. I can feel confidence is a lot weaker than, as you mentioned, I've been doing this for over 20 years. So every year I go to China. So last trip, I feel the Chinese sentiment, business sentiment, business confidence, and private businesses, even civil servants, government officials, their sentiment is quite low. So that's why I think they need some pretty significant policy push to change that.
Yeah, and thank you. I'm going to take one more question from the audience. There's a couple of questions actually coming in very quickly. Youth unemployment, we've heard a lot about that in China, continues to rise. Could this become a problem for the CCP, and what can be done to address this?
So I think that's a great question. I think that's why I'm still hopeful China will eventually be forced to take more aggressive actions. First of all, Chinese government does respond to the weak growth numbers, and second of all, I think that's a great question. If a bunch of young people, without jobs, without income, then you may have social unrest. So they would have to take actions to address those kind of issues. So that's why, if we think back towards the end of last year, why Beijing all of a sudden abandoned zero COVID control, right? So it's because back then the social pressure, the economic pressure became so extreme. People were protesting. They were protesting on the street. So I think from that we can still understand the reaction function from Beijing is acute economic pressure will push them to react.
Yeah, thank you very much for that. It's unfortunately all the time we have. There's a lot of questions coming in. Maybe we should organize another session with you. It's been extremely insightful. And thank you for, again, early hours in the morning and joining us here. And to our audience, thank you for all the questions. Yeah, and we hope to speak to you very soon in the near future. And again, thank you so much from our side.
Thank you so much. Have a great event. Bye for now.
Thank you. Good. Moving on to our first topic of the day, global growth and emerging markets. And joining us now all the way from Harami, Fort Lauderdale, is Shalanta De Silva from GQG Partners. Good morning, Shalanta. Very early Wednesday morning where you are, I believe. I think you're still on mute. We all do that.
Yes, good morning.
Yeah, fantastic. We can hear you. I can't see you yet. I can see your colleague, maybe just for the audience as well. GQG, the representative in South Africa, is Southern Right Capital. Gideon Nieuwoud joining on the line as well. But Shalanta, are you going to drive your own slides, I believe?
Oh, we will. Gideon's going to drive it for me.
Yeah, it's coming up. If you can maybe put it in full presentation mode. Almost there.
There we go.
Yeah, fantastic. I can see all the fine print. There's GQG now. Great stuff. Thank you very much for that. And thank you for joining us today.
Thanks for having us. So let me start with why emerging markets today, right? GQG is a global asset manager. We manage a large swath of capital in a global product. We have an international product and an emerging market product. Reflective of our positive bias towards emerging markets, an unconstrained portfolio is our global book, which is our top 50 best ideas. Within that, our emerging market exposure has been increasing, reflective of that constructiveness we have on EM. And the backdrop to this is that today we're in a very unique environment where EM has lower inflation than DM. EM sovereign balance sheets are more solvent than that of DM. The reality is that Europe, for example, has more EM problems than EM itself. EM is anchored to commodities, right? Over index there, commodity demand isn't fading. If anything, it's increasing. Trends like decarbonization are only going to intensify the need for more energy and more commodity consumption. And decarbonization is extremely energy intensive, right? And we're not seeing a corresponding response on the supply front. The outcome is that EM sovereign balance sheets are seeing a lot of dollar reserves come in. Banking systems are very solvent, right? And have been seasoned through the COVID trauma the world has faced. And so they're very well positioned to capture the upside, support the economic momentum as things normalize globally. And even with the debate on recessions in EM demand is still sustaining at a substantial clip. And EM is a funny asset class where there's always a good and bad EM, right? We have this very homogeneous name allocated to a heterogeneous roster of earnings and GDPs, right? So we have to be quite active in terms of where in EM you want to position yourself. Despite our aggregate positive bias, we're still quite selective as to where we want to be. And the natural debate is within EM, where do you park yourself? Now, this chart actually reflects a bias or an area that we've been very constructive on, which is India, right? And this is not, this is earnings growth of Indian equities versus that of Chinese equities. And we've seen a considerable outperformance in India. And reflective of that, our largest exposure today is India, right? And our largest underweight is China, given that we're seeing a deteriorating environment. So we go to the next slide. You will see very clearly why we have pared down our Chinese exposure, right? For the longest time, Chinese ROEs have been that superior to that of broad emerging markets. And today, we're actually seeing Chinese ROEs that are subpar to EM and at a considerably lower clip to that of India, right? And therefore, we have taken a large underweight to China, given the ground reality. Now, this is reflective of, call it regulatory burden put on the system, leverage, common prosperity, the uncertainty there that's brought about into corporate life. The reality today is that every company in China has national service risk, right? And so what we have done is looked at businesses that are pricing that risk in, which have monopoly-like architecture embedded into those franchises. And interestingly, the bulk of the exposure we have today is state-owned enterprises. Why? Because it's in the price. The sovereign is very focused on growing these businesses, and they're yielding a considerable amount and giving us protection on the downside because of that. Now we have almost a 1,500 basis point underweight to China, but what we own there is low multiple, high yield, sovereign-backed franchises, such as Wulang in consumer staples, commodities, and select financial services. If on the next slide, the importance of managing risk is adaptability, right? And this showcases how adaptive GQG is as a risk manager. In 2018, we were well above our peer group and index. We saw the anti-IPO being pulled, the regulatory burden increase on Chinese tech companies. We receded exposure. After we saw that tech burden absorbed, valuations coming off, and things sort of normalizing, we increased our exposure. Today, we have taken our exposure down substantially on the back of the uncertainty of common prosperity, a slowing environment, weaker relative earnings growth, return profile aka ROE, versus that of the rest of EM, right? But I don't want to portray that we feel China is uninvestable. We do have exposure. China is a big part of emerging markets, and in one sense, it's a quasi-optical underweight. See, we have close to 20% in energy. We have close to 20% in Brazil. When you own Brazilian equities, you're actually getting Chinese growth without taking that domicile risk, right? So we've picked strong points within China today, and we capture Chinese growth through other areas within our portfolio. Combination of all this is how we've been able to hold up well above that of the index. And that adaptability factor is why we sit with a beta or a risk profile in the portfolio at 0.7 or lower, right? And I think it's important, especially in EM, where it is higher octane, to be a bit more conservative when underwriting franchises and putting on risk. So net, we're very constructive on EM today, but very selective as to what we want to own. We're in the large mid-cap space. Why? Because 80% of the net profit pool in EM sits with the top 20% of market cap. In periods of strife, these businesses that generate good returns are able to redeploy it with a very strong visible return profile. And that keeps us in the most liquid parts of EM, which do matter in periods of crisis, because you do find liquidity gravitating to where we sit, right? Quality growth is what we see as the strong points in EM. And if I go west to east in terms of our portfolio, sizable all the way to Latin America, given the growth profile and improving visibility there. Underweight to EMEA, right? For, I would say, obvious reasons that we have to face within an Asian context, underweight North Asia, and overweight South Asia, aka India, with a smattering of opportunities we picked out in Southeast Asia. Let me pause there. I'm happy to take questions on broad EM, and maybe I'll pass it on to Gideon to add a few words to what we do.
Tulaka, thank you so much for that. It's a bit like speed dating today. It's very quick to crunch in a whole lot of information. And I think, but the one thing I think that stands out is your ability to adapt to markets. That probably speaks to your solid long-term track record. Very quick question from my side. You've got two funds. You've got an emerging markets equity fund. You've got a global equity fund. So for clients, that's maybe, you know, they like what you do, being adaptive, looking at different areas of markets, looking at growth, but they want to access your skills, but not necessarily an emerging markets fund only. How does your global equity fund differ from your emerging markets mandate?
It's considerable more diversified, right? Within global, US is the largest piece. We have a lot of European exposure, but you know, the domicile is Europe, but they actually capture growth elsewhere in the world. Call it a Louis Vuitton, which is, you know, a quasi-Chinese stock. So we are able to get the strongest 50 franchises, I use a generic number here, to capture global growth. And so the global fund has a lot more technology today, less energy, versus the EM fund has a higher skew towards energy. And that's the opportunity set that we're dealing with. The one common narrative is that we are decisively underweight China in both these products.
Maybe, Eugene, a comment that I can make, because if one look at GQG under the leadership of the CIO, Rajiv Jain, got the north of 30-year track record. And interestingly, the outperformance of both those products over their respective very gold standard indices are around between 250 and 300 basis points on an annualized basis. Interestingly enough, since we launched the South African feeder funds in South African rands, the outperformance on the EM product, so far so good. We've promised there will be outperformance over the long term, but in the short term, it's the EM product have outperformed with 1,000 basis points and 850 or so since the inception with the BCI or the Sunrise BCI product. The consistency in terms of long-term performance of EM have had a long sort of walk in the desert, so to speak, with the US leading the way. But over the long term, over that almost 30-year period, both have compounded around 10%, which is quite interesting, especially considering the walk in the desert that we've had. And year to date, I think both the global as well as the EM products are up about 15%.
Yeah, definitely. I do concur with that. Solid track record as well. The feeder funds may be a little bit new to us, but like you said, you know, the direct global fund's been going for a very, very long time. Gentlemen, unfortunately, again, all the time we have to our audience out there, we will make the presentations available to you as well as the recordings. And if you want to get hold of GQG, more information on that, give us a shout and we'll get you in contact with either Shananta or Gideon, based here in South Africa. Gents, thank you so much. It's been very insightful, although very quick. Right, we'll chat in the near future again.
Thank you.
Thanks a lot. Our next speaker for the day on Global Equity Outlook, and very familiar to all of us, presented in most of our sessions from when we just about started, with a formidable track record as well, Patrice Moyal from Visio Capital. Patrice, good afternoon, and thank you so much for joining us today. I can see you.
Can you see me and can you hear me?
And I can hear you. Fantastic.
Okay, good. And you can see
Thanks,
the presentation?
Yes, perfect.
Okay, great. Eugene, BCR, Tanya, Robert, everyone, Olga, thank you very much for the opportunity. We always value it tremendously. So I'll be fairly brief. Just the background, we've been active in markets for a very long time, offshore and local. Our hedge funds in South Africa since 2003 have held offshore shares, so it's not new to us. I think we were the first to put corporate bonds in BCI's funds in 2009 after the financial crisis. So even corporate bonds, dollar bonds, etc., are something that we've been doing for a long time and analyzing the companies behind those bonds. We've got good grey hairs in terms of property with Mike Flex more recently. Keris is London-based. We've got someone in Australia. I'm traveling a lot more overseas these days. So we definitely are expanding our knowledge further than what we know already. As you know, it's tremendously huge global market. There's no set formula, quite honestly, to invest offshore. There are just so many different permutations, so many different formulae. From our perspective, it's always been company specific, kind of bottom up, even though there's a lot of themes and geographies that will drive selection offshore. But in the main, it comes down to companies. And themes play a big role, and to a lesser extent, geographies. You could be in a difficult geography and find a great company. We're not going to try and cover everything. I would challenge any fund manager in the world to actually say they cover everything. It's impossible. So I think at the end of the day, focus on themes, for example. Our themes are quite exciting. It could be, so I'm just taking my watch off to keep time. Basically, it could be it's emerging consumers. So there's been a lot of talk about China and Japan, and obviously India. So we are very much in tune with what's going on there. We used to be in China every year until COVID. It was great to hear Young One's comments on his recent visit there. We're spending time in India. I'm actually going to be there in October on a whole string of business meetings. We've already put some exposure in our funds in India. But it talks obviously to the emerging consumer spend. Energy transition also spoken about, and the incredible demand for new materials and all the mechanics that go behind it, from refining, from recycling batteries. There will be some plays in recycling batteries at some point also. Storage is obviously an important theme in terms of energy. Biotech, we made a right call, although small. It was an initial small position in Novo Nordisk, but we've seen the benefits of that. You know, nothing ventured, nothing gained. So again, we did the homework. We've got a model on Novo, got a smaller model on Eli, trying to get that one going, Eli Lilly, but we've seen the benefits of what obesity drugs can do to an overall health, containment of health issues, from heart disease to diabetes, etc. So there's some incredible new developing ideas globally, and it's nice to be able to participate in those. And then from the digital age, I mean, I'm not going to dwell on generative AI and what's going on there, quantum computing, energy through fusion, etc. Again, so we're not going to cover everything. We are going to be company specific. To give you an idea, we're also not going to reinvent the wheel. We'll find good companies. There will be, the bulk will have cash on balance sheet. If you look at just the spread of some of them that make up the portfolio, whether it's in our global equities fund through BCI, or our hedge funds also through BCI, or flexible mandate, these will be the same type of holdings. You'll see the ROEs are high. You'll see that, okay, dividend yields are not the most attractive given the company's ratings. However, these are good, solid, long-term businesses, dominant in their space, and all able to weather, you know, the type of recession we speak about, etc. End of the day, something like a Microsoft, we haven't put it here, but we hold it, is again mutating itself into a different animal. Visa is an incredible platform. It will be hard to disintermediate Visa. Yum China is growing organically, notwithstanding the current challenges in China. Again, recently the results were pretty outstanding, sitting on 4 billion of cash, or 20 billion of the market cap in pure cash. These are some of the $3 billion. These are some of the ideas that are in the funds, company specific again. TSMC playing towards the semiconductor space. Again, something that will be required in every sphere of activity globally. This is the makeup of some of the holdings in the funds. You can see we pride ourselves on transparency, so you'll always know what we're holding. We also like the fact that we are company specific, so we will have models on these companies. We will have done a lot of in-depth homework over many years. Some themes are more recent, such as Novo Nordisk. Universal Music Group only listed 2.5 years ago, but what an outstanding, almost universal theme in terms of music and its long-standing merits, not just from an investment point of view, but from a social perspective, from a development of themes and ideas and what comes about through music. So nothing better. What a privilege to be able to invest in a company like Universal Music Group for the long term. It's a good pension fund. It's a good retirement stock. It's something that you will enjoy, the product thereof, and to have these types of companies to invest in is tremendous. So it's a bit of an eclectic bunch of companies. We are not overly exposed to the US. As you can see, it's 51% of the portfolio, but in actual fact, 16% of that is sitting in hard cash, earning 5.5% in dollars. So we haven't fully deployed firepower that we have. I think it just talks to trying to be a bit more conservative and selective. World's all over the place at the moment. From a European perspective, there's a tremendous amount of value, and that talks to some of our penchant over the years towards looking for value, looking for downside protection. We cannot profess to be brilliant investment managers internationally, given our roots in South Africa, but we can at least profess to be very good risk managers, given our roots in South Africa. And for that reason, we will always look for downside protection. And our heritage in hedge funds, through Visio, also talks to the fact that we will tend towards risk, being more risk averse than trying to find growth. So companies like VW, a bit of a value trap at the moment, but it's a position we will look to develop over time. Vivendi is offering tremendous value as a sum of parts business. Unilever's got a new CEO, CFO, chairman, so potential for that to turn around, and they've had a few mishaps, so the opportunities there. So these are just some of the ideas. Then, Tony, we've got slides on Alibaba in terms of the sum of parts of Alibaba in China. It's too. If we give you an idea how we break down the value, so this is Alibaba, for example. if you break down its various parts, which they've announced they will look to unbundle, to actually break up this group over time. If you add up the various parts of Alibaba, plus the cash on hand, which is in the order of over $60 billion, the stakes that they have, such as in Ant and a few other companies, you get to a value that is, which offers more than 50% upside. And that's taking a fairly conservative estimate on the multiples that we're applying on the various parts of the business. So we're not being aggressive in terms of what we are looking for from Alibaba. Yes, short term, the catalysts are few from a Chinese perspective, but we're not going to try and time it. We're not putting money here for the next 3 months, but this is the type of underlying opportunity we like to be able to tap into. So again, we've got some other slides. I assume these presentations are available for general consumption. I think perhaps the other comments I want to make, we've also recently invested in Japan earlier this year. We did quite a bit of work on the various value propositions in Japan, of which there are plenty. And that led to us investing in non-small companies. In fact, they're names over here, from they in engineering to media to even road pavements, road material for roads. But the underlying premise on all these companies is embellished in the box over here. The market caps on average are $1.4 billion. Some are more than that, some are smaller than that. The cash part of those market caps on average represents half the market cap. The investments that they have in underlying other holdings, given the heritage of these Japanese companies holding so many stakes in each other, is another 50%. So in essence, without even looking at the operations of the businesses, you've got the entire market cap made up of both cash and other holdings. That is the average metrics which apply to these 9 companies that we've invested in. We've put 0.5% of the funds across our hedge funds also in each of these underlying stocks, together make up 4.5% to 5%. But that gives you optionality on what the Japanese intend to do over the coming periods in terms of unlocking this tremendous value that sits within these corporates. So you could go and invest directly in a Japanese fund, you could go and buy some of these stocks individually, or you can say, well, let's pick a South African manager who's risk averse, who likes these types of value opportunities, plus some of parts propositions. It can be in Europe, it can be in Japan. There's one in Alibaba in China. The others are different, have different makeups. And that gives you, as I said, a mix of opportunities globally through a fund in South Africa with managers that are a bit more global than in the past, with our focus far more on international exposure over in the past years than it has been in the past. Yeah, I mean, I'll stop here. There's a lot more I could say. I can talk a lot about India, but I'll be able to talk a lot more about it after October. Needless to say, we have taken 5% or put 5% in India already. We're not going to wait until we've seen exactly. One of our guys has already been to India last year. Maybe last comment to make, South 32 is also there. Talks about renewables, the tremendous demand there is for commodities going forward. And this one plays very well to the decarbonization theme, given its portfolio of assets. Thank you. I'm going to stop now, conscious of time.
Patricia said to you, it's impossible to cover the world, but hell, you do cover a hell of a lot looking for those opportunities for clients. Maybe just a quick question. Some of your holdings that you hold in your portfolio, things like Meta. I mean, Meta ran extremely hard so far for the past 7 months. Alphabet, Microsoft also doing extremely well. What's your view on those companies? I mean, can this go on? It just seems like, isn't this the top if you just look from a PE level, which is a very blunt tool given, but, is this the end or is it just going to keep on going?
Yeah, well, I think you've got to look at the underlying propositions that they offer to the global customers, the pervasiveness of their products, the incredible amount of R&D that they spend, which outweighs any other company in the world. You cannot compete against the $53 billion that Google spends a year on R&D, or the amount of, Meta is losing will lose about $10 billion on its reality labs this year. How many companies can afford to lose $10 billion plowing money into these types of ventures? $10 billion. So that has to be moats that will, over the longer term, stand them in good stead, given the products that they're putting out. And we know the reach that Meta has through all its various offerings. So these are companies that are way too dominant and well ahead of the curve, notwithstanding all the noise out there.
Very tricky question. I mean, a lot of us sit with a little bit of FOMO, missed out. And I mentioned, a lot of us were very much defensively positioned at the beginning of the year. Maybe a bit of an unfair question. Do you think it's a good idea to still upweight or increase global equity exposure at this point in time?
Yeah, absolutely. I mean, it's a huge universe. There's so many opportunities. We're not even covering 1% of it. I think this choice, the range, it's just the beauty of being able to look at different opportunities globally, from Latin America, which we haven't spent enough time on. I understood GQG's quite active there, to anywhere else. Japan, it's a tremendous opportunity. India is just phenomenal. And then China should come off a low base. Maybe it's 2024. But the bases are low in China.
Very insightful indeed. Patrice, again, thank you so much for joining us today. Again, apologies for the very short time. And yes, just to confirm again, the presentations will be made available. A lot of information in there. We will circulate it through to the audience. Patrice, we'll chat to you again in the very near future. Thank you so much. Right, joining us now all the way from London, Andrew Clifton from one of the top global asset management firms, already established in 1937, T. Rowe Price, looking at global value investing and opportunities at a time of dramatic change. Good morning, Andrew. How are you?
Good morning, Eugene. We are very well here in London. Thank you for the chance to talk to your clients. So what I propose to do in the short time available is to talk about our Global Value Equity Fund, but really, given the excellent introduction by our China expert, also to really use China as an example of our process in action, and to tell you how we're approaching that market and what our exposures are in that particular region. So if we can just look on the next page, just really to give an introduction to our fund. It is locally rated Citywire Gold in your marketplace. Essentially, the Global Value Equity Fund is looking to exploit controversy. Markets are often inefficient. An anomaly that we observe is whenever there is any fear or uncertainty towards a stock, the share price can become far more detached from its intrinsic value than is really merited by any fundamental consideration. So we look to use our insights to assess whether this is merited and whether we should engage and invest in the business. And critical to this is our research team of over 200 analysts, not just in London and the United States, but we have teams as well in Shanghai, Hong Kong, and Singapore to help us with stocks in that region and China specifically. Critical to us in terms of getting involved is the asymmetry of return. There will always typically be downside remaining in value-oriented opportunities, but if we are being compensated more than, say, by a 3-to-1 ratio in terms of upside to downside, then we are prepared to take on that downside risk, but also we will carefully control for position sizing in those more risky situations. And we do take on a lot of risk, but we also take on a lot of defensive companies as well. And as we say on this page, we invest across the value spectrum. So we invest in defensive, higher quality companies such as healthcare, staples, and utilities, where there still can be controversies, but they do offer a good degree of defensiveness. But we exchange quality for upside. We also invest in lower quality, higher risk, cyclical and deep value names. And we find that this gives us a nice breadth across the portfolio. Just a few words on parameters, especially as it relates to our China exposure. We are primarily, well, we are benchmarked against MSCI World, but you'll see here we have scope to invest up to 10% in emerging markets. And you'll also see that we say we're diversified across sectors and regions, and you'll see that that is the case, but also across the market capitalization spectrum. And again, investing in China, we have found more opportunities lower down the market cap range than amongst the mega caps that most investors know and those companies that are in the headlines. So 80 to 100 stocks looking to capture the best global value ideas that we can. And on this next page, it really just encapsulates, the next page after the risk page, please. It just encapsulates the market anomaly in action. And you'll see in terms of weights that can detract from a company's shorter term performance, geopolitical uncertainty, and also economic and market outlook. And certainly those two factors are impacting many Chinese companies at the moment in terms of their valuations and share price performance, along with those other widespread considerations such as product issues or management issues or leverage risk. But essentially, when we have these controversies, we need to be confident that they can be resolved. And if they can be, we can look for the share price to recover. Just on the next page, just very briefly, a bit more detail on how we invest across the value spectrum. The reality is that different types of value are effective at different times. And in defensive risk off markets, defensive value will typically provide a lot of protection and generally keep us performing well relative to the MSCI World Benchmark. But at certain times in value regimes, in risk on markets, the market is not interested in defensiveness. It wants to have higher octane, more cyclical and deep value companies. And we also do engage and have a lot of exposure in those types of situations. On average, around half of our portfolio will be defensively placed and the other half will be in the cyclical and deep value grouping. But it does evolve according to where we find the best opportunities. What you get with the portfolio shown on this next page is a clear value footprint. You can see that our price to earnings ratio is materially below the MSCI World Benchmark for a similar level of earnings growth currently forecast. The price to book ratio is about half that of the wider benchmark and is broadly in line with the MSCI World Value Benchmark. And the return on equity is lower than the market, as you should expect, given the quite reasonable exposure in the fund to lower quality, more cyclical and deep value companies. One other statistic to highlight on this page, just again illustrating the point about the market capitalization exposure, the investment weighted median market cap is appreciably less than the market as a whole. And that is because in many markets, including China, we do find more undiscovered opportunities than can be found amongst the large caps and the mega caps. From a sector basis, on this next page, we are overweight for traditional sectors where there is usually a greater value footprint, that of financials, utilities, and energy. These are very much driven by the bottom-up stock-specific opportunities, but it is true that those sectors do very often have a greater value representation, and we find appeal in certain companies in those sectors. Amongst the more growth-oriented sectors of IT and consumer discretionary, you'll see that they are our biggest underweights, perhaps again, no surprise. But again, all of this sector positioning is driven by the stock-specific opportunities. And you'll note that healthcare, for example, is one of our bigger overweights, notwithstanding the fact it's not really value-oriented. And that is because many companies in that sector performed poorly a few years ago when the market was looking for more cyclical exposure. That gave us opportunities and we added to the sector at that time. From a regional basis, on this next page, you can see that although we have a good representation in the United States, as it is close to 70% of the benchmark, it is largely funding exposures in other parts of the world, not least Europe, Japan, and also emerging markets. You'll see here that I indicate we have close to 10%, our maximum level in emerging markets, and China is around 2% of that. The other markets we have exposure to are Brazil, India, South Korea, and Vietnam. And again, given the volatility in markets and relative valuations, we do like this opportunistic ability to take advantage of emerging market exposure. And on this next page, we can just really see why the Chinese opportunity is presenting itself. Other presenters have already commented upon the low valuation of the Chinese market, and others, I'm sure, will repeat that sentiment. But that is the reality of what we're faced with, and it's indicative of the broad controversy towards that marketplace. But again, at an individual stock basis, we need to be very careful about where we're taking exposure and how we are controlling for risk. This next page shows how the indices have dramatically changed in terms of the makeup of the China representation over the last few decades. And as our first speaker said, there has been an incredible resurgence in manufacturing and also technology over the last couple of decades. So technology is very often seen as the key exposure for investing in China. And indeed, on this next page, you can see that many of the overseas investors in China, you have the top 10 funds on the right-hand side, are very heavy, those mega cap names, that is largely made up of tech companies. But on the left-hand side, this is what we find appealing about China, an incredible breadth of opportunity. The vast majority of companies are not in the benchmark and are very often not really featuring in the portfolios of many of our competitors. And just on this next page, just to close on the point as to where we are seeing our specific most attractive opportunities in China, we have two holdings currently, Yangjiang Shipbuilding and BOE Veritronics. Both of them are really great indications, firstly, of the general theme that was mentioned by our earlier speaker of China being tech savvy, but also low cost. Yangjiang Shipbuilding is China's largest private shipbuilder, the 5th largest shipbuilder in the world. It has got a very clear cost advantage over other Chinese manufacturers, but also its foreign competition, particularly based out of Japan and South Korea. It's listed in Singapore. It's about a 5 billion market capitalization. We have owned it for almost getting on for 3 years, during which time it has performed well. But essentially, our analyst has identified the remaining potential for this business in a shipbuilding cycle that has really recovered very strongly for the last couple of years, but actually now is really further gathering steam. And many delivery slots are now full up, both with this company, but also with its competitors for really the next 2 to 3 years. And at the same time, our analysis indicated that because of increasing regulation of the shipping fleet around the world, there was an increasing need for greener production of container vessels, and Yangjiang Shipbuilding is very well placed in that regard. So a great example of how we can get exposure to very specific stock opportunities in a market that has been very depressed, but in a business that we feel is really relatively well insulated from those broader concerns towards the Chinese market. And in closing, the second investment that we have within our Global Value Equity Fund is BOE Veritronics. It is one of the world's largest manufacturer of panel displays for passenger cars. It has incredible growth opportunities. It is really well invested. It is listed within the technology sector, but essentially is very kind of uncorrelated with those bigger Chinese technology companies that are often in the headlines. As I mentioned, it's been incredibly well invested. It's got very ambitious growth opportunities, but its valuation has also been very depressed by broader concerns towards not just China generally, but also the Chinese automotive market more specifically. So if we're just going on 2 slides to my summary slide, performance is there, and that can be seen in the kit subsequently. But the reasons why to invest in our Global Value Equity Fund, I mean, essentially, we are looking around the world, including to emerging markets, to find the best, most attractive 80 to 100 value ideas that we can find. We invest across the value spectrum because different types of value are effective at different times. And we believe that we can really have strong insights that guide us towards those best stock-specific opportunities. And it's really a value investing approach that is capable of performing in a range of environments. In difficult times when value is out of favor, our defensive exposures have given us a good degree of protection. And when value does return as a favored investment regime, and again, we may see that occur in the not too distant future, similar to what we saw in 2022, when our more cyclical, more deep value companies mean that we should participate well, again, in any value recovery that occurs. So thank you, Eugene, for the time to talk to your audience. And let me stop there and see if you have any questions.
Andrew, thank you very much. I don't see anything from the audience, but maybe sticking to the point of different spectrums of value. You also had the one slide where you showed value or more defensive value. It appears again as if risks are increasing of a recession. Feels a little bit foolish talking about it because we spoke about it a lot beginning of the year and then it disappeared. And now people are talking about it again. But does that push you to lean more towards defensive value type stocks? And if so, do you maybe have an example of that?
Well, certainly over the last 12 months or so, we have been leaning slightly more defensively. So having just a bit more than a 50% allocation to defensive opportunities. But it is interesting that in the last 3 to 6 months, at the margin, we have found more opportunities in more deep value or cyclical names, particularly areas such as US financials, where clearly there was dramatic disturbance in market expectations following Silicon Valley and other events towards the end of the first quarter. So that is where we have been finding more opportunities at the margin. But in terms of to answer your question more specifically, in terms of defensive opportunities, then the usual sectors where we find a lot of opportunities are things like healthcare, utilities, and also consumer staples. And staples is a sector we have been adding to quite appreciably within the last 6 to 12 months. But also, healthcare less so. Healthcare is a sector which has been performing reasonably well. So at the margin, we've been trimming. Utilities, again, gives us good exposure to defensiveness, particularly in the US. And both high quality names such as Sempra, but also other more controversial names like PG&E, which the market we still views as far too controversial. So a true world of opportunity. I've mentioned the China names we have exposure to, but around the world, we can still find a lot of very attractively value-oriented opportunities.
Very insightful indeed, Andrew. Thank you so much to our audience out there. The BCI T Rowe Price Global Value Equity Feeder Fund is on most platforms. You can also access it through some of the direct offshore platforms. Andrew, thank you so much for your time. Great seeing you again, and we'll chat to you again in the very near future. Thank you.
Thank you.
Right, our last session before tea break, again on a topic that remains in the forefront, continuing on China. We are now joined by Robin Yu, based in Hong Kong, that managed the Riskira BCI China Equity Fund, which is a multi-managed fund. Good afternoon, Yu. You there?
Good afternoon, Eugene. Thank you.
Got you loud and clear. Robin, again, thank you so much for joining us today. We really appreciate it.
Thank you so much. And also, I'm joined by our head of research, Faisal Rafi. Faisal, do you want to say hi?
Hi guys, I'm having some problems with video. I terribly apologize. I'm trying to set it well.
No problem. We can hear you loud and clear.
Excellent. Thank you. I'm sorry about that.
No problem.
Yes, thank you everyone for your time and the opportunity for us to present our current thoughts on the China market. A lot has happened in the past 2 years. I'm sure you have get the flavor from other presenters so far, but we might have a slightly different views on the market, and we would like to share that with you. Please, can we move on to the next slide? Yeah, so this is basically what we expected the market to do after China reopened from COVID. Basically a two-stage recovery in the market. And we have seen the first stage happened in late 2022 and earlier this year. We saw a big rally in the market, a very strong rally, up 30% from late last year to end of January this year. And it was a lot driven by multiple expansion as the overall market sentiment improved. And expectations for growth also came back after China opened the market. So we saw very strong data from anything travel, tourism related, restaurants, small ticket items, even exports were doing much better than some people originally expected. So, but the problem was people were extrapolating that early stage recovery, and people were expecting immediate recovery in all the areas in the China economy. So that became a disappointment when data softened in the second quarter. But focusing back to the first stage, we have seen strong rally driven by the reopening plays, turnaround assets in the market, both offshore and onshore. And there was actually one surprise in the market that a lot of people didn't expect, was the market was large in the beginning of the year, largely driven by thematic trading in the areas of anything relevant to artificial intelligence. So that's no different from the rest of the world. And then also we've seen the state-owned enterprises, they have a strong revaluation, despite the earnings is not coming through, but there's a coordinated effort by the government to talk up the sector. And also, so driven a lot of inflows flowing into the SOE sector, that's a lot of the retail and mutual fund money. No active manager, or at least most of the managers, do not hold these names because fundamentally they don't make sense in the long term. As we know, anything AI related is still very early stage, and some of the companies in China, some of them are world leading, but some of them are not. But the entire sector, had a huge re-rating, and we have already seen that re-rating being reversing in recent months. And then SOEs also enjoyed the rally that I mentioned. So a lot of managers do not hold these names, and hence the underperformance year to date. That's across the board. That's a surprise that we didn't expect at the beginning of the year. But nevertheless, we don't think this is sustainable. As I said, ultimately, stock share price should reflect fundamentals and long-term cash flows, earnings of a company. So we're not too worried about that. For example, the underweight to these areas for good reasons. For example, SOEs, a lot of them are the state-owned banks. They are more like a policy tool to when the economy is doing well, they tend to save some profits, and when not doing well, you expect them to use it as a tool to support the economy. So overall, they're not very well governed and well managed assets that you want to own in the market. On the other hand, there's much stronger assets, core assets in the consumption, in the new energy space that one would want to hold in the long term to enjoy the benefit of the Chinese growth. So that's the first stage. The second stage, which has not come through yet, as we still think that it will come through. It's just a matter of time when it will come, but we have high confidence that this will come, because ultimately the share price will be driven by fundamental and earnings improvement. But currently, what the market is, it's obscured by a lot of the macro noise, macro data. As I mentioned, the disappointment. People were expecting the government to put in more effort in terms of stimulating the economy. There are some efforts put in, but frankly, not enough at this stage. We expect to see more, as I will explain in the next two slides. But the market needs to see some catalysts, or need to see some stabilization in the economy before they can refocus back on earnings, on fundamentals. But ultimately, we think this is what drives companies' share price. And ultimately, we invest in the companies in China, not the broad economy. And there's 5,000 of companies in China that we can choose from. And in the portfolio, there's only 100, 200 stocks. So, so despite that, year to date, some of these portfolio holdings, they have seen earnings improving from last year, but share price has not moved, and some even came down, and so resulting in valuation has come down even further from last year. So going forward, we think very important to monitor consumption, the consumption, the data, property sector, its sales, and also geopolitics that that we can move on. Thank you. And we want to remind everyone that China does not have the same inflation issue that is faced by most of the Western countries. When US, Europe, UK are battling with 6%, even 10% inflation, China inflation has been very low in the recent years. And recently, even in the deflation zone, but it's only temporary and driven by the pork price down 26% year over year. So we think it's temporary. We're not worried about the deflationary kind of situation or risk for China. But yes, low inflation will be there for some time. And we think this is actually a supportive environment for the government. If they want to do something, they can do it. They can actually put on the big gun and then cut interest rate massively, print money. They can even they can increase government fiscal spending a lot. But so far we have not seen that yet. So far the government has been very careful not to kick the can down the road, not to create long-term issues that they have seen in the Western countries, high inflation, etc. And this is also going against, the government's objective from quantitative growth to quality growth, that they have put in place a few years ago. So they want to make sure that this is, sometimes short-term pain for long-term gain, but at the same time, they want to put a floor to the pain. As we have seen in late July, the Politburo meeting, the government has sent a very strong dovish signal that they were going to do something. And the recent news in the property sector, in the even like the CPI, PPI, they're not reflected of the latest view yet. Like you need time for them to take measures, for the actions to come in and to start working in the economy. So it will take time, and we do expect to see more policy coming in the next few months. Confidence still has a long way. Consumer confidence still has a long way to recover. Some people, as you can see, after the opening of COVID, there is a pickup in confidence, but it's still below 100. Some people are disappointed about the development there. But if we compare China to the rest of the world, for example, India and US, the experience was not that out of sync. If you look at the line there, it's still in the same direction. US probably picking up faster than India, but largely in the same direction. So we are not that far behind. It takes time for, especially for the big ticket items, to come back. As the economy stabilize, as the property sector situation stabilize, we think that can change very quickly. As sentiment in China can swing one way from the other in a short period of time in a big way. So we think this is not the time to be too bearish, especially when the valuation, the price has already reflected most of these negatives. For this, I will hand it over to our head of research, Faisal, to walk you through the remaining slides.
Thank you very much. We just move on to the slide. Look, the worst is not over. Property is still a big part of the total GDP. I'm sure commentators have talked about before. This is just sales compared to previous years for Country Garden, which is kind of the last surviving highest quality private real estate developer, and even they are having liquidity issues. You can just see by the pink charts that in July the sales were less than July last year, which was during COVID lockdowns. Look, the portfolio does not have any real estate or direct real estate development in the portfolio. What the portfolio is really focusing on is what we're kind of going to focus on, which is the real earnings growth in interesting and exciting companies that people would want to invest in China for. So you can go to the next slide. So what's happened since? So we talked to you about last year, where the picture in China was no different to any other country in the world, including South Africa or the USA, which was there were COVID lockdowns, people were not going out, and even the highest quality businesses in China really couldn't do business. So what we had seen in other countries was that was temporary, and that was always going to be temporary. It was temporary, and that ended end of last year. And companies have very definitively delivered earnings growth. However, the prices have not moved to reflect the movement in the earnings. And as a result, the PE ratios are now back to where they were last year, which was one of the darkest points of history for Chinese stock markets. But where we are today is largely the country's back to normal. Companies are delivering the earnings growth, but what we're missing on is this confidence in the stock markets, which really is going to come through in a form of the Chinese government providing the much needed stimulus that the economy needs. The stimulus, that's a very much of a political issue. The Chinese government really has been, what it really doesn't want to do is get into the troubles that the West has got into. They've seen the crazy stimulus led to super high inflation, and they're and that will bite into the Chinese consumer, and that's what they're very careful about. So they're being very, very careful. What they also don't want to do is overstimulate property too early and get into the same property booms and busts. So they've been very hesitant. However, they've been making very clear signals more lately about helping the stock markets, the economy, and as a result, July was a very strong month for the stock market because of that. But what we're really waiting for, if just move over to the next slide, please. What we're really moving for is the prices now to reflect the fundamentals. Earnings, I've kind of talked about the first bullet where the earnings are really there, and in terms of trends and themes, they've continued to dominate. So last year, China became the second largest exporter of cars in the world by overtaking Germany, and then this year, China has overtaken Japan to become the world's largest exporter. In literally a few years, we've seen brands like MG and BYD and other Chinese brands really grow rapidly across Europe, across the African continent, across Asia. In the last 3 months, I've personally seen the abundance of these cars show up in the Gulf. India, a lot of the EV vehicles being sold are Chinese. We're seeing that, we're hearing that coming across the same point in South Africa. That in itself feeds into multiple industries that just go into the EV industry and car industry. There was just there's an article around the FT now coming through of why the world can't transition to zero emissions without China's need. There was another article talking about, the two types of battery technologies that go into electric vehicles. The one that's most popular, China has 99% market share. And the Koreans are struggling to move on to that technology. Similarly, there's been an incredible recovery on internet stocks, e-commerce stocks. They are not only out delivering inside of China, but they are also expanding internationally. So, for example, Pinduoduo, which is the third largest e-commerce company in China, today is now rapidly growing in US and Europe under the brand Temu. I'm going to stop at that. I think we've overrun our time. But that is really the message. We really now need the share prices to reflect what's actually happening at the companies.
Faisal and Robin, thank you very much for that. Very insightful indeed. Very quick question. We are out of time, but quick question. Being a multi-managed fund, your outlook on China, does that have an impact of the managers that you appoint or hold in the fund?
It did before, fortunately. So I'll give you a very example from a multi-manager's perspective. One wants diversification across different styles.
Yes.
And during the good years of 2020, if you recall, tech stocks across the world really rebounded. And what we started seeing was a massive growth bias that was developing across the portfolios. So before the market turned, we actually proactively added, very specifically went out finding value managers and added that to the portfolio. That was very, very, and that they have been the strongest performing managers of recent years. So we very gladly did that, but we did it from a risk management perspective, which is our job as multi-managers.
Yeah, it's very interesting indeed. It's true. It's an all-out equity fund in China, but like I said in the beginning, multi-managed. But let's talk about A&H shares. Do you, with times like perhaps now, have a preference to A shares, mainland China, and how do you manage that in the fund?
I'll let Robin combine add, but to start with, the benchmark looks at A and H shares in their availability, meaning from a bottom-up basis, the total market, including A and H. That's how we manage this portfolio, which is about even balance between stocks listed in mainland China and offshore. The reality is that what we're looking for is asset managers to find the best companies at the best pricing. And that leads at the top level, sometimes the bias towards A shares, sometimes the bias towards H shares. So that should be free moving depending on the opportunity at the bottom up level.
Right.
Yeah, so the managers have the freedom to choose what they think are the best opportunity for the individual portfolios, but at the total fund level, Faisal and I kind of manage the risk and making sure that we are not deviate too much from our benchmark, and we need to be cognizant of the risk, and at the same time whether we are getting payoff for the risk that we're taking.
Very insightful indeed. So the managers will make those underlying calls on behalf of clients. You don't have to worry about that. Robin and Faisal, thank you so much for joining us. And Robin, all the way from Hong Kong, thank you very much. We'll chat to you again in the near future. To our audience out there, we are going to break now for tea till about 1:15. So be back 1:15, where we will kick off on double credit. And we'll speak to you in a few minutes. Again, enjoy your cup of tea and your scone. Right, I hope you're all well refreshed with a new cup of coffee in front of you. And thank you and welcome back. Joining us now from Fairtree Capital is Louis, who you all know very well, on a very hot topic as we near the peak of a rate hiking cycle. Maybe not quite there yet, but yields most certainly looking extremely attractive, especially in the global credit world. Louis, good afternoon, and thank you so much for joining us. We really appreciate it for your time today.
Thanks, Eugene. Good afternoon. I'm going to speak to you about the BCI Fairtree Global Income Plus Feeder Fund, which has been enjoying a period of good performance. Base rates have increased, credit spreads are wider, and the fund has suffered no credit losses to speak of over the last while. And then in addition to this, it's had a boost from the weaker currency. If we can just go on to the next slide. Okay, so as I said, I'm going to speak to you about the BCI Fairtree Global Income Plus Feeder Fund, but because it feeds into the Fairtree Global Income Plus Fund, I want to spend most of the time speaking about that fund, because the credit fund, I'll show you what's been happening in global credit markets and the impact on this fund. We'll look at performance of the fund and then the outlook of the fund going forward. Okay. So BCI Fairtree Global Income Plus Feeder Fund. This is the performance since inception in July. You can see it's quite a volatile return series. Year to date to the 31st of July, 15.41%, year on year 29.07%. So great numbers, but you need to remember this feeder fund has got 100% exposure to the Euro-Rand exchange rate. So that's been a big boost to performance. And in fact, I mean, with this latest bout of weakness we've seen, as of yesterday, year-to-date numbers would be 22% and year-on-year 36.6%. So the currency is quite a big component of the performance. So to give a proper assessment of the fund, we need to look at the fund that it feeds into, which is the Fairtree Global Income Plus Fund. And let's just change the slide. So this is the performance of the fund, calendar year performance, going back to inception in 2019. And you can see the difference in performance between the two, between the Fairtree Global Income Plus and the feeder fund. This again is due to the currency, but nonetheless, great performance from the Global Income Plus Fund, 7.33% to the 31st of July and 12.64% year on year. This is hard currency returns. These are returns in euros. So the fund has done particularly well over the last while. We move on to the next slide. So what is this fund? Fairtree Global Income Plus, it's a high yield credit fund. It invests in defaultable debt securities. It's a UCITS fund, which it provides a high level of protection to investors, not least of which is the 5-10-40 rule, which simply states that maximum exposure to any one name can be 10%, and all exposures greater than 5% in aggregate have to be less than 40% of the value of the fund. It's domiciled in Dublin. Its benchmark is the iTraxx Crossover Total Return Index. This is an index of the 75 most liquid sub-investment grade European names, all equally weighted. There's also no modified duration interest rate risk in the fund because the fund is comprised mostly of floating rate securities which pay a spread over a base rate. In our case, it's Euribor or the European short-term rate. Now, the fixed coupon instruments in the fund, we hedge back to floating basis using derivatives. So we don't have any interest rate risk or modified duration. So recent movements that you would have seen in bond yields have had absolutely no impact on this fund whatsoever. It's a roll-up fund. It doesn't pay distributions. Income's rolled up in the fund, so it's a tax-efficient entity. This is the sector exposure in the fund. It's a well-diversified fund. It has about 40 instruments in it. However, about 60% of the fund is in indices or parts of indices which reference 75 to 100 names. So it's a very well-diversified fund, which is what you would want in a credit fund. On the next slide, if we look at its currency exposure, as you'd expect, predominantly in euros, 83% in euros, a little bit in dollars and a little bit in pounds. But this is all academic because non-euro exposure is hedged again with derivatives back to euros because it is essentially a euro fund. We go on to the next slide and we have a look at what's happening in credit markets. This is that iTraxx crossover index. It's a CDS index, credit default swap index, 75 most liquid European sub-investment grade names, equally weighted. And these are essentially spreads. So they're spreads over Euribor. And you can see previous periods of stress in the system where credit spreads have blown out quite dramatically, as we had in 2008 and 2009, which was the European, the global financial crisis. And then again in 2011 and 12, which was the European sovereign crisis. And then we went through a pretty calm period of about 6 years where we didn't have too much excitement until 2020, where we had the onset of COVID-19 and lockdowns. We saw a big kick up in credit spreads. They since came down. And then at the beginning of last year, we started to see upside surprise in inflation coming through and the associated aggressive policy tightening from central banks. And we saw spreads widen quite dramatically, well over 600 points. On the next slide, if we have a look at it on a shorter time frame, you can see that 2021, in terms of credit spreads, is a very benign environment. Spreads remained were contained in a band of sort of 240 to 280 basis points. And then from the beginning of last year, we started to get these upside surprises in inflation, and central banks started hiking rates quite aggressively. Then Russia's invasion of Ukraine just added more fuel to the fire. We saw a spike in energy prices and food prices, and spreads really took off to sort of well over 600 points. Then from about the third quarter of 2022, you started to hear talk of pivoting, or the possibility that peak rates were approaching and might flatten. The rates may flatten, policy rates may flatten off and possibly come down from there. And we saw spreads then start to contract again. And they've come back just over half of what they sold out, of what they sold off in the first part of last year. So what has been this default experience? Obviously, these spreads are widening because market participants are fearful that aggressive increases in policy rates will push leverage companies into bankruptcy and will have an increase in defaults. If we go back and have a look, these are these iTraxx crossover indexes. They're 5-year indices, as I said, European sub-investment grade indices. They're reconstituted every 6 months with a new series of index. So going back to series 1, all the way back to series 1 in 2004, up to the current one, S39 now. And these are the number of defaults that are implied by the pricing of that index at inception, implied by the spread on that index at its launch. If we look on the next page, we can see what the realized number of defaults have been. And you can see that we've been amply compensated for the default risk that we've been taking, being involved in European credit. So the defaults have been much lower than expected. You can also see, even notwithstanding the fact that policy rates have been quite aggressively hiked over the last couple of months, there's been absolutely no increase in defaults. It's been ominously quiet. And we'd have to go back all the way to series S34, which is 2.5 years old now, to find the last credit event that in fact affected this fund. And that was on the 2nd of December 2020. It was actually Europcar. And there were no credit losses from that in any case, because the recovery on the name was 100%. So there's been a dearth of credit events, which has been great for the fund. So here's this index again, the iTraxx crossover total return index. At this time, it's in total return space. This is the benchmark of the Fairtree Global Income Plus Fund. And it's a fully funded index. And it's just to show you the effect of spread widening that we had in the first part of last year. where spreads widened, as I said, from about 240 or 280 basis points to over 600 points. This index in the first part of the year sold off quite a bit. It lost around 13% of its value, but it's come back quite quickly. So even now, it's about 3.5% above where it was at the end of December 21. And that's the result of the higher spread, as well as the increase in base rates, all of which has been positive for this fund. If we go on to the next slide. This is, as I said, the instruments in the fund are floating rate notes that pay a spread or credit spread over a base rate. In our case, it would be Euribor. This is 3-month Euribor, which is being phased out in favor of the European short-term rate. But nonetheless, it's the same chart. And if you see for the past 8 years, these rates have been negative until the middle of 2022, and now they're nicely positive. So we've got an increase in the base and an increase in the spreads, which has been great for the fund. And we've had a complete lack of defaults. Okay, so performance. What's the scorecard been like? This is calendar year performance. This is Fairtree Global Income Plus. It's benchmark, the iTraxx crossover total return index, and the BCI Fairtree Global Income Plus feeder fund, which obviously has the currency exposure. And just to show you the difference in returns over periods, you can see the influence of the currency on the returns. And year to date and year on year, the euro rand lost year to date, it's lost around 7% to the end of July, and about 13% year on year. So that's added a nice boost to the returns in the feeder fund, but it's also a benefit from good returns in the Fairtree Global Income Plus fund. Also, you can see the currency makes it a bit more volatile. So 10.93, a bit higher than the volatility of the Fairtree Global Income Plus at 9.56. We look on the next slide. These are annualized returns together with the benchmark. You can see over the short term, Fairtree Global Income Plus, this is the class D again, because the feeder fund doesn't pay another layer of fees. It pays one set of fees in the feeder fund, and this is the zero fee class in the Fairtree Global Income Plus fund. So 12.64% versus 14.55%. So it's slightly behind benchmark in the short term, but over the long term, you can see it's outperformed the benchmark 5.3 over the last 3 years to 4.51. And then you can see the impact of the currency, the weaker currency over the last 2 years on the feeder fund. It's been a nice boost to performance, but it hasn't always been the case. If you look a little bit further out, over 3 years, it's actually underperformed the hard currency fund to a slight degree. This is Fairtree Global Income Plus together with its benchmark and the BCI Fairtree Global Income Plus feeder fund. You can see that Global Income Plus it's tracked its benchmark quite nicely, outperformed it quite nicely as well, and it also shows you the volatility introduced by the currency in the feeder fund. So it's a lot more volatile than the Global Income Plus fund. So what is the outlook for the fund? Well, the outlook remains very positive. Credit spreads are still wide, so the opportunity for reinvestment is improved. The weighted average spread of the fund remains elevated. It's in excess of 400 basis points at the moment. If you couple this with base rates, Euribor up at 375, they remain elevated. It doesn't appear that these are going to come down anytime soon. And the fact that even with this quite aggressive tightening of central bank policy rates, we have yet to see any marked increase in defaults bodes well for the fund. So we're quite positive on it going forward. It's in a good space at the moment. Thank you.
Kerry, thank you very much for that. And maybe just to reiterate, our audience are very familiar with your local fund, the BCI Income Plus Fund, also managed by Fairtree, where you do have some exposure to the global fund, which you spoke about now, but there the currency is hedged. In this fund, there is no currency hedge, so you obviously get the benefit or not of currency movements. Maybe just a very quick question on the fund as well. I mean, global interest rates very high at the moment, short-dated global cash, US dollar cash, giving clients fairly decent returns. This could be a good fund for clients considering de-risking or taking some risk off the table. What can clients expect from your fund above global cash, also at high yields at the moment, going forward over the next 12 to 24 months?
Well, I mean, it's a difficult one to say because there are a whole lot of assumptions you have to make about what credit spreads are going to do and what base rates are going to do. But if you just have a look at where base rates are at the moment, we know what, I mean, they're sitting at 375 odd, and we say, well, the fund's generating around 400 basis points above that. That's at 7.5%, 8%. I think would be a reasonable expectation. Obviously, in the feeder fund, you know, you have the currency, so that's a huge.
Can't call that.
I mean, yeah, how long is a piece of string? But in the in the Euro fund, yeah, all you can do is you take market inputs and say, well, we know what the spread we're achieving on these instruments is, the weighted average spread. We know what the market's expecting from the base rate from the Euribor going forward, and we can add those two. And then we have to work in a bit of a margin to say, well, we most likely will suffer some credit losses over the period. We're not immune to them, but being a well-diversified fund, they're not too onerous.
Really put you on the spot there, Louis. Sorry for that. But again, you know, a very good alternative if clients are looking to take some risk off the table and you don't necessarily want to repatriate assets. A very good alternative to cash and enhance yields on that. Louis, thank you very much for joining us. We'll chat to you in the very near future again. To our clients, I see there is a question from one of our audience members in the previous session. Are there feeder funds available? Yes, all the funds that we are looking at today, there are feeder funds available in the BCI stable, and we'll definitely circulate all that information through to you as well. Right, we're continuing on global equity, and joining us now is Andreas van der Horst from Mazi Asset Management. Mazi, perhaps a new name to a lot of us. We've got a feeder fund launching for them in November 2023, but Mazi's been around for a very, very long time, for 16 plus years, managing an excess of 40 billion with a well-established team of investment professionals, total team of 45, with 10 specifically looking at global equity. So well-experienced team. They've come a long way, really good track record as well. So we're excited to be launching a feeder fund for you, Andreas, and thank you so much for joining us this afternoon. And how are you?
Eugene, thank you for the glowing introduction, and also to Tanya and Robert, thank you very much for the opportunity to present at your global webinar. And we're also very honored to present to your valued DFMs and IFA partners. We feel particularly privileged to be included in a lineup with global equity managers that we greatly respect. Today, we're going to talk about our philosophy, our process, our performance, and also touch on some risk management. We believe that our investment philosophy and process has to stand at the center of everything we do and deliver a result that is consistently excellent, synonymous with quality and performance, and above all, our process has to be repeatable. We believe the foundation of our approach to investment is best said by Sir Isaac Newton when he said, "If I've seen further than others, it's by standing on the shoulders of giants." We acknowledge our quality-focused investment process is built on the work of a great many giants. Taking on board the teachings and practice and temperament of some of the greatest investment minds will make us successful. And we fully recognize that in the work we do, we stand on the shoulders of giants, and we remain in search of tomorrow's giants. Warren Buffett is one such giant. Once a value investor, his days of cigar butt investment are long gone. It was Charlie Munger that put the good sense into his head. It's better to own a great business at a fair price than a fair business at a great price. Today, Buffett is probably the ultimate quality investor, a giant in our own time. If we express our investment philosophy in a single quote, it will be, we seek to buy shares in a great business for less than the business is intrinsically worth, with managers of the highest integrity and ability, and then own those shares forever. What does this practically mean? Firstly, we look for businesses that are run by highly experienced, disciplined, and honest people. Avoiding corporate frauds is at least half of our job. Secondly, we want companies that think long-term in all aspects of their business. Long-term focused businesses survive tough times and thrive in good times. Next, we look for a management that makes rational capital allocation decisions. In other words, economically sensible decisions. Decisions that balance the customers, the company, and the shareholder needs. Decisions that produce sustained profits over time, well in excess of the cost of capital required to make that profit. Furthermore, we want high barriers to entry and exceptionally strong competitive positions. Moats, as Buffett calls it. These barriers can be brands, large installed bases, valuable distribution networks, and hard to replicate intellectual property, to name a few. And they need to widen with each market cycle and demonstrate ongoing resilience to the macro events that come. Equally important, our businesses need to grow at a decent clip. There has to be long-term organic growth at high returns on invested capital. It is this growth opportunity that makes our businesses much bigger and more valuable with the passage of time. When you put all of this together, it usually shows up in the numbers. If the numbers don't add up, don't do it. Profit margins are stable, structurally wide, and resilient to inflation, producing over time a growing stream of excess cash for shareholders. Returns on invested capital are high and remain high, well in excess of the cost of that capital. That is, the company generates economic value for its shareholders. Cash earnings and shareholder funds compound with time. Ultimately, we want businesses that are good for shareholders and do not reward management or customers or suppliers or the government at the expense of the shareholder. Lastly, the crucial ingredient in our investment process is patience. When you find an exceptional business, buy it at an attractive price and settle in for the ride. We are long-term investors. Our portfolio turnover is less than 10% per year. If we reduce our process to one number, just one idea, what would it be? Return on invested capital. It's the one number that sums the total of all capital allocation decisions in the business of a life, in the life of a business. It provides a view into the heart and soul of the functioning and capital productiveness of the business. Look at global markets through the lens of return of invested capital, and we can see the following. Since 1995, the median company has earned a return on invested capital of about 8.7%. This is what the company makes on its capital. This is the green line in the graph. The weighted average cost of that capital has been about 7.6%. This is the red line. This is what the capital costs. In good years, there's been a positive gap, the gray bars. The median company has produced economic value add. In bad years, the benchmark company has destroyed shareholder value. If you plot a cumulative figure for the spread, the purple line, then the median company has only delivered 1.1% over the cost of its capital. This is hardly something to write home about, given all the risk you take. So, what do we want? We want businesses that are substantially better than the average. This is the return on invested capital graph, but for Deckers Outdoor. Altogether a different story. This is a business we own and bought at the right price. Deckers is a global footwear brands company. You're unlikely to have heard of Deckers, but you're probably familiar with Hoka running shoes and UGG boots. The business is highly profitable and growing quickly at about 20% per year. Return on invested capital exceeds 30% with a cost of capital of about 10%. This is an excess cash producing machine. Plenty of growth opportunity and runway here. But let's compare. Nike is the darling of the investment industry. You'll see Nike in many portfolios, but not Deckers. Deckers, however, is growing much faster with better margins and is intrinsically more profitable. Yet, Deckers sells only 30 million pairs of shoes a year, and Nike sells more than 700 million pairs of shoes. On a market cap basis, Deckers is about 1/10 of Nike's size. Trees don't grow to the sky, and on valuation grounds, Deckers is way more attractive. In our hands, Deckers has already doubled. From here on, Deckers is more likely than Nike to double again in price. Running shoes are but one thing. This is the Mazi Global Equity Portfolio. This is what you get if you invest with us. You'll know Google, Visa, MasterCard, Microsoft, Schindler, probably a couple more. But there might be a bunch of companies you don't recognize. These businesses are even more impressive and operate completely out of the limelight. Amadeus, ASML, Cadence, Fastenal, Pro Medicus, Zoetis, all exceptional high-quality businesses with years of profitable growth to come. Run your ruler through our businesses and you'll find rational capital allocation, sane management, structural profitability, moats, and above all, the opportunity for reinvestment in future growth. All up, with patience and despite the macro that may come, these businesses will be multiples of their size. Giants in time to come. The table on the left shows our top 10 return contributors for the one-year period ended 30 June. On the right, we show the top 10 for global equities. Ticks and crosses denote whether we own the stock or not. You've heard the throwaway comment. Tell me your performance and I'll show you your portfolio. Our portfolio does not require any particular theme or market positioning to perform. We did not need to be right on this year's news, ChatGPT, NVIDIA AI chips, or you've got to be in Apple because it's the biggest business in the benchmark, or last year's story on oil and gas, or the recovery of mega banks. Only 2 of our top 10 contributors are tech. Arista and Cadence aren't even household names. Microsoft, Facebook, and Google, top 10 performers in the index, do not even make it into our top 10. Our performance truly comes from a diversity of quality businesses, irrespective of sector, ranging from footwear and apparel to luxury goods to cosmetic retail to auto repair, auto insurance value chain, and even something as futuristic as robotic surgery. Let me leave you with one message: an investment strategy built on a quality-focused, profitable, growth-oriented portfolio held for the long term delivers a consistent above benchmark performance that emanates from a diversity of successful businesses, not the market flavor of the month. Our investors have been rewarded. We launched the Mazi Prime Global Equity Fund a bit more than 2 years ago during the lofty market heights of COVID euphoria at peak market valuations. On the left, we present our performance in Rand. On the right, we show the dollar numbers. Our fund is entirely invested offshore. Dollars paint the real picture of what's going on. Over 1 year, we're well ahead of benchmark. 18 months, we're on track. Over 2 years, there's a bit of catch-up work to do. Where do we stand today? We expect our good performance to continue in all likelihood and to make up the lost ground over the 2 years and since inception. Why do we say this? Valuation multiples for both the market and our portfolio have substantially stepped down from the COVID high. US long rates have repriced from 90 basis points to 420 basis points. And based on consensus numbers, the growth outlook for our portfolio of profitable companies over the next 2 years is almost double that of the market. Quality investment strategy delivers over time. One last slide on risk management. We define risk as the permanent loss of capital. A portfolio of quality businesses, by virtue of the intrinsic nature of the companies we invested in, protects you, the investor, on the downside. Moreover, these companies tend to surprise more often than not on the upside. When times are tough, something all businesses go through, quality businesses take market share. The weak get weaker and the strong get stronger. We strive to own the strong get stronger businesses. All told, a portfolio of quality businesses delivers higher returns over time at lower levels of risk. The numbers speak for themselves. Thank you. Please feel free to get in touch with us for a coffee. Please take a look at our website and our LinkedIn profiles for more details. Eugene, over to you if there are any questions.
Yeah, thank you very much for that. We're very much out of time, but I've got a very, very quick question for you in 30 seconds. To partly understand your screening process and how it works behind the scenes, why would you not invest in a company like NVIDIA?
The valuation is completely out of kilter for us.
The valuations on which matrix?
So we have developed quite a sophisticated set of valuation tools, and essentially when you look at NVIDIA, it is not a prodigious producer of free cash. In fact, it raised cash at the recently it raised about $10 billion. And so fundamental for us in terms of our quality focused investment process is, A, does it produce a lot of free cash, evidenced by a very, very wide spread between what it earns on its capital and what it pays for its capital. And then secondly, the growth that is there, and then what are you paying for that growth? And if you understand that relationship well, then by our criteria and our standards, we will not invest in NVIDIA. We don't see a return for our shareholders from these levels on.
Provides a lot more insight in terms of how you guys think. I know it's a very short space of time to give an introduction to your company. We're really looking forward to launching your feeder fund in November. But as you mentioned to our audience, if you want to get hold of Marzi and Andreas, give us a shout and we'll get you in touch for more info. Andreas, thank you so much for your time today. We really appreciate that. It's an introductory presentation, and I'm sure to see lots more of you in the very near future. Right.
Thank you again, and you're most welcome. Bye-bye.
Staying on global quality, and a presenter that needs absolutely no to little introduction to any of us is Greville Ward from Fundsmith, looking at the Fundsmith Global Equity Fund, one of the largest funds in the UK.
Eugene, I think
right, I'm terribly sorry.
Coming up.
I'm terribly sorry. It's my fault there. Things are getting mixed up here. I can see Greville on the call. He's actually waiting. But first up, apologies for that, is Ben van Leeuwen from Lindsell Train. Ben, my apologies for that. I almost skipped over you. How can I do that? And again, you know, all the way from London, Ben, thank you so much for joining us and giving us an update on Lindsell Train and how you see the world. To our audience out there, I mean, Lindsell Train's been one of the longest standing asset managers globally and manage huge portfolios with the promise to their clients protecting the real value of clients' capital. And if you look at their history, they've done exactly that. Ben, again, apologies from my side, and thank you so much for joining us.
Not at all. Hopefully people will be able to differentiate between Greville and myself. But yeah.
Definitely.
Thanks, Eugene, as well for clicking through. Yeah, first two slides are just the usual disclaimers. My plan for the 15 minutes is a quick firm introduction. Then I'll take you through our investment philosophy, a couple of individual stocks, and then we can finish on performance. And then maybe 1 minute for questions. So this is Lindsell Train as a business. We were founded in the year 2000 by Michael Lindsell and Nick Train. They retain the majority of the ownership today. There is another stake held by the Lindsell Train Investment Trust, separately listed on the London Stock Exchange, and then other directors and staff own the remainder. Every employee is pictured on this slide. We're a fairly streamlined organization. Everything is as horizontal as possible so that everyone can focus on the main purpose, which is running client money properly. And just to flag that we run 17.5 billion sterling. Next slide would be great. Thanks, Eugene. So we run 4 strategies: global, UK, Japan, North America. Global is the only one badged for the South African market. And so that's the one I'll focus on today. But we have the same philosophy across all 4 geographies. Great. So investment style. Some of this may sound familiar. I'm sure that quote on the right-hand side will definitely sound familiar to anyone who's listening to the previous talk. But at the heart of our approach, we are trying to invest in truly exceptional business franchises that we think other investors persistently undervalue, and then just hold on for the truly long term. We also define risk as the permanent loss of capital or the chance of that happening. And we think the best way to mitigate that is by owning a small selection of truly exceptional companies that you know inside out. And then finally, just to really reiterate, if we just go back very briefly, we do have a very long time horizon. So we're not in the game of predicting 1, 3, even 5-year figures. We are looking for the kind of companies you can safely hold for 20 years and be fairly confident that they will still be around and thriving. And the way we can come to that level of hopeful certainty is that we invest in companies that are on average 120 years old already. Brilliant. So when we talk about high quality companies, again, we would direct you to one statistic, which is some version of return on equity, capital employed, or invested capital. We can have a separate discussion about all of those another time. But as you can see, our portfolio as it stands today has a weighted average ROE in the high 20s, but more importantly, it's sustained one in the 20s for the last 20 years, which is double that of the index. And all of these return metrics mean is that our companies can generate higher earnings from the same dollar of retained earnings or invested capital and so on. And if our companies can then reinvest those cash flows at these high rates and keep doing that over and over, you get this phenomenal compounding effect and you get some real right tail outcomes. And the next slide will briefly illustrate that. As you can see, it's a very high level example, but if you have a company that sustains a 22% ROE over a 20-year holding period, you are able to pay above market rates. You're able to see that multiple revert to the mean over time, and you will still lock in a higher than average return because that superior compounding more than compensates for that valuation headwind. Great. So on to the next slide. Where do we find these exceptional companies? We think there are only a few parts of the market where they can be found, basically. Alcoholic beverages, certain parts of software, financial exchanges have long been an interest to us, household and personal care, and certain parts of media. We do try to avoid other parts entirely, the energy sector, cable, anything where they either have to rely excessively on leverage to generate their returns, or if they're dependent on external factors like the price of a commodity like oil. We like to be a bit more in control of our company's futures. We also have never invested in tobacco for ESG reasons, dating right back to the inception of the strategy and the firm itself. There's a lot of labels on that slide, but this slide has a few buckets which would kind of, solidify what we're really looking for into 3 areas. And they are very simply consumer and healthcare franchises, where we find exceptional long-lived brands that have premiumization opportunities and emerging market growth. Media and software companies, a slightly broader label, but you could include everything from academic journals owned by RELX to Disney princesses or Marvel superstars in this category. And then financials and networks, where you get these very, very powerful network business models, whether that's a payments company or a stock exchange, and the value of the platform increases exponentially for every incremental user. We really like that space as well. And now on to the next slide. This is our portfolio as it stands today. Anyone who's heard either myself or one of my colleagues speak before, hopefully a lot of these names will be very familiar because most of them have been held since inception back in 2011. There have been a few changes, often through corporate activity. And it's probably worth flagging 2 names in particular, which are Prada on the left-hand side and FICO in the middle, which are the 2 most recent additions to the portfolio over the last 5 years. So we really do have an exceptionally low turnover. It is quite difficult to kind of convey a sense of the fun from just the list of names though. So I thought I would go through 3 stocks in particular, one from each of those buckets, and here's number 1. And so this is Cadbury, one of the leading chocolate companies in the world, and it's owned by a company called Mondelez. So Nick Train actually invested directly in Cadbury as a standalone company almost 30 years ago now. and then we followed it into Mondelez when it was acquired. And the reason is simple. We love chocolate and snacking as a category. It's an affordable luxury. It's a frequent repeat purchase. Consumers are exceptionally brand loyal, and private label penetration is incredibly low. This is one of the lowest private label penetration categories in staples. And all of that combined means you get fantastic pricing power. And yeah, someone at Mondelez very kindly sent us the data for the price of a dairy milk chocolate bar starting in 1905 all the way to the present. And as you can see, they've more than been able to outstrip inflation through price hikes over more than a century. So, you know, people are talking about worries of pricing power over the next 2 years, the previous 12 months and so on. This company has been doing it for over 100 years so far. And if you look at the most recent results, they are still managing to achieve it with little to no effect on volumes. So it's clearly an exceptional category to be in and one we're happy to hold. Number 2 is WWE, the World Wrestling Entertainment Company. If anyone has never seen a WWE bout before, I strongly recommend you go onto YouTube and increase those 70 billion views by a few more. WWE is actually the 4th largest YouTube channel, which just goes to show how popular this content is globally. It's a really slightly unusual form of content. It's a mix of live sports, just like a football game. You know, people are tuning in weekly to watch these bouts as they occur in real time. But it's also a soap opera. It's actually the longest running scripted soap opera in US history. And people watch for the characters, for the storylines, people like The Rock or John Cena and so on. So it's a really sticky combination. And the result is that media companies pay vast amounts to secure the rights to this content. And then WWE locks in those revenues for the next 5-year period or so. And as you can see, we're waiting on the latest deal, and we think that it will be a pretty nice uplift given that the streaming services are now really interested in this space as well. Brilliant. Now, the final one, this is a slightly underfollowed asset, but it's owned by the London Stock Exchange. And the asset is LCH, or the London Clearing House. And clearinghouses are amongst the most important pieces of financial infrastructure out there. And LCH is responsible for one asset class in particular, which is interest rate swaps. And it has a 90% market share here. And since 2009, to make this a bit more tangible, it's cleared over $2 quadrillion in this instrument. And it's just the perfect example of why we love network businesses. You know, more participants and greater liquidity, creating this virtuous circle, and it's just basically impossible to get a toehold. And it's worth pointing out that some of these interest rate swaps are 50-year instruments. So banks are trusting that LCH will still be around in 2080 to make sure that clients are still posting collateral and honoring trades. So it's the kind of time horizon that we love to see for our given businesses. So those are the 3 examples. Now let me move briefly on to performance. As you can see, since inception, all the way back into the early 2010s, the Global Equity Fund has nicely outperformed. In recent years, it's been a bit more of a struggle, and the reason is simple. It was 2021 in particular that proved a bit of a challenge. The market was up 20% or so, and we were flat. And there are a couple of reasons. We do over-index and really like owning consumer staples because we love the certainty of the cash flows and the long-term time horizon. But they obviously suffered as people were unable to go out and drink Heineken beer and Diageo's Johnny Walker whiskey in bars and so on. We also mildly under-index to tech. It is a sector where we do struggle to have that 20-year time horizon. There are companies in that sector we do like accounting software operators like Intuit and so on. but our exposure is marginally lower there. But we've now lapped 2021, and we look forward to returning to the usual levels of outperformance as we go forwards. And I think we've got 1 minute left for any questions.
Ben, thank you so much for that. Truly insightful. I don't see any questions from the audience, but I mean exactly that. We've been learning about compounding returns since we were in school days, and especially financial planning. That's exactly what we find with Lindsell Train in your fund. The BCI Lindsell Train Global Equity Feeder Fund, obviously also available on all the big SA platforms. Just quickly back to the London Stock Exchange, because a big chunk of your portfolio is one of your top holdings, close to 9%. How does that pricing power compounding effect work on a stock exchange?
It's a great question. It's hard to summarize in 30 seconds because it's no longer really a stock exchange. It was a stock exchange dating back to the 1600s. Since then, it's bought a number of companies. You have an indices business, which is a bit like MSCI. You have a data and analytics business, which is a bit like Bloomberg. And then you obviously have the core stock exchange where they get fees from listing and from trading revenues. So pricing power is flexed very differently across all four segments. But yeah, I wish I could go through each one individually and explain how it's done. But yeah, it is one that has managed to still compound for us. And even though it was flat in 2021 as well, it's been more than a 10-bagger for Nick since his initial investment.
Yeah, that sounds very great indeed. Ben, thank you so much for your time and dialing in all the way from London. We really appreciate your time this morning. And apologies again for almost skipping you. That would have been so bad. Ben van Leeuwen, Lindsell Train, we'll chat to you again very soon. Right, now we're over to Greville, that's been standing by and eager to go. Greville Ward from Fundsmith, talking to the Global Equity Fund. Greville, you online? There you are. Yes, he's still on mute. No, still on mute. There we go.
There we go. Is that all right? Can you hear me?
Yes, fantastic. Greville,
perfect.
How are you?
I was very well indeed, Eugene. I was just thinking that it'd be much more fun for your listeners when we do this again, if in fact I do present on Lindsell Train and Ben presents on Fundsmith. What do you think about that?
That would be fantastic.
Well, thank you very much indeed for having me once again, and welcome everybody. Welcome particularly to those of you that have just dragged yourself away from the Women's World Cup semi-final, where England beat Australia 3-1. Brilliant, brilliant performance by the England ladies. Much more interesting than anything I'm going to talk to you about today. So Fundsmith Equity Fund, if we could go on to the next slide, and then probably, yeah, that's fine. So this is performance so far this year in sterling, up 9.4. We've done a little better than that in dollars, a little bit behind the benchmark, largely because we are not heavily involved directly in AI stocks, particularly NVIDIA, which obviously is a huge index participant for reasons mainly of valuation, but though not entirely. But we hope that when people look at that screen, they look over at the right-hand side and see that since we started in 2010 in November through to the end of July this year, the fund's up 15.6% in sterling against the MSCI World in sterling of 11.4. And also this year, 7/12 of the year, we're sort of roughly on track for something like that kind of return. Right, let's move on and look at what has worked for us and what hasn't worked for us so far this year. On the left-hand side, you can see that the major performers, pluses and the minuses on the right. I'm just going to mention two companies only, I think. Firstly, Meta Platforms, just because I think it's a good example of us doing what we say we do. And what we say that we do at Fundsmith is rely on the numbers. We are assiduous at doing enormous amounts of work to make sure that the numbers add up and these companies are as good as we hope they are. And we try and block out the noise. And I think we can all agree that there is and has been a lot of noise around Meta in the last 4 or 5 years, both good and bad. We bought this stock at about $175 after the Cambridge Analytica scandal. It went up quite nicely after that. It then went down a lot, as you will know, and got down to $75, $80 at the end of last year. And there were lots of people shouting at us and telling us that we were mad to own it and that their daughters and sons weren't using Facebook anymore. And the business was essentially all over. But the numbers didn't suggest that to us. And purely from an advertising point of view, we think that it's too big to ignore. And so we did hang on to it. And it'll come as no surprise to hear that it's been extremely good this year so far, and it's now trading back over $300 a share. Just sort of for the doubters, of which there are still quite a few, and to give you a couple of factoids, if you like. 3 billion people a day use one of the three main Meta products, those being Facebook, Instagram, and WhatsApp. 3 billion people. Now, none of those are allowed in China. If you take 1.5 billion off the world population of 8, you get 6.5, which means that Meta's getting to, or being used by, pretty close to half the world's population. And it's that strength which means that big companies can't really avoid using it to advertise. In March of 2023, March of this year, Facebook had 53% of all social media visits. The next highest in March of this year was Twitter at 16%, Instagram at 14%, and Pinterest at 13%, just to show you the might of the original platform, the original Facebook that everybody thinks is all over and nobody uses it anymore. It's really not backed up by the numbers. So I only illustrate the point that if the company still looks good to us, even if the share price goes down, we're happy to hang on to it. If something changes, we may rotate out of it or sell it. But if the numbers look okay, then I think Terry and Julian usually do a very good job at blocking out the noise. On the right-hand side, the one that we're concerned about is Estée Lauder. They recently made a bit of a mess of Asian travel retail. They said that it wasn't going to be a long-term problem, that they could sort it out. I think the jury's still out on whether they can sort it out or not. And it is counter to what L'Oreal on the left-hand side of the screen has been doing recently, where they're doing very well in Asian travel retail. So we do think this is not a sector issue, it's an Estée Lauder issue, and the jury's still out as to whether or not they can sort that out. Okay, let's move on to the next slide, which is that. This is what we do. We only invest in good companies. We try not to overpay. And then we do the hardest thing of all in active fund management, which is nothing. Let's move on. And the next slide is really kind of the only, well, it's not the only, it's the most important slide that we put up. So all we're showing here is the return on capital employed, mentioned by some of the previous presenters, but that is, in our mind, the best way to judge whether a company is doing well or not so well. And if you look at the return on capital employed for the funds with equity fund portfolio for the last 7 or 8 years, you'll see that on average, our companies are producing an ROCE of 28, 29, 30% against the S&P 500 of 18 and the FTSE 100 of 16. You'll also see that our companies have significantly higher gross margins and operating profit margins, which, by the way, is a good thing to have in a time of higher interest rates and or higher input prices, because they are able to often pass on higher costs to the end consumer. But in gross margin terms and operating profit margin terms, those numbers for the portfolio are significantly better than the indexes, the S&P and the FTSE 100. And our contention here is fairly simple, which is that if you own better companies in the market, and if you can prove that you own better companies in the market, and if those companies are compounding and taking their internally generated cash flow and reinvesting it back into their business at these high rates of return in order to grow and compound, then it shouldn't be a huge shock to you if you're a medium-term investor, and we hope everybody is in the Funds with Equity Fund, if you get a better return than the index, because essentially you are investing in better companies in the index, which are growing and compounding a little bit every day, irrespective of what's going on in the world in terms of sort of macroeconomy. So that is, we put that slide in all of our annual letters, semi-annual letters, in all our presentations. It is far and away the most important thing that we show people. And for as long as those numbers look as they do, I think investors have reason to be reasonably comfortable. Okay, let's move on. The next slide shows valuation. So we look at free cash flow yield. Funds with equity fund trades on free cash flow yield 2.8 currently, which is a little bit lower than the S&P non-financials. But again, because we think we own substantially better companies in the market, it doesn't concern us greatly that the fund is a little bit more expensive than the market. The free cash flow yield has actually come down a tiny bit this year, A, because the fund's done well, because the stock prices have gone up a bit, but also because for various reasons to do with the unwinding things that happened in the COVID years, the free cash flow growth has slowed a little, but is forecast to pick up fairly handily over the next 18 to 24 months. So it's not something we're terribly concerned about. Yep, we can move on, please. Even though we're a buy and hold fund, we do occasionally take action when things go wrong or when we get it wrong. I think when I spoke at the BCI conference in May, we talked about Adobe and Amazon, so I'm not going to go over those again, but I will talk about Procter & Gamble, which we used to own. We owned it when we started the fund in 2010. We sold it in 2016 because we believed that they weren't getting a lot of volume growth from some of their major brands, notably in Gillette, in razors, and Pampers and diapers, and Tide and laundry detergent. And we felt that they were somewhat underinvesting in these huge brands, and they were just putting the prices up to try and mask the fact they weren't getting any volume growth. There has been a change at the top of Procter & Gamble in the meantime, and we think the new regime is doing a much better job at investing in their very, very sort of high value brands, and has, as a result of that, started to get quite decent volume growth again. So I think when we sold it, we said at the time, it's something that we'd be happy to own in the future if they can up their game a bit. And in our view, they have done that. So we used a moment of share price weakness to get back into Procter & Gamble. But I think that also proves the point, which is that when we sell stocks, they go back into the investable universe and could easily re-emerge in the portfolio if certain things change, or particularly if the valuation changes. Okay, yes, let's move on, please. I'm just going to do 2 more slides. Here's the first one. In terms of sector split, very little has changed here, except certain companies have been reclassified by MSCI, which makes that slide a little bit confusing. But in broad terms, there's 3 sectors we invest in: consumer staples, healthcare, and technology in its broadest sense. Even though we have a financials number there, that's Visa. We don't really think of Visa as a financial company, but it has been reclassified as such. But in broad terms, there are principally only 3 sectors that we invest in: consumer, staples, healthcare, and technology. Just to remind everybody, that's not because we've taken a top-down view of those 3 sectors and think these are the good ones to invest in. It's because if you take a bottom-up approach at trying to find great businesses in the public market, of which we don't think there are that many, they happen to be clustered in those sectors for fairly good reasons. When your dog food runs out, you go and buy more. When you need your hip replaced, you go and have a hip replacement. You know, these are not terribly economically sensitive events. So that's why we're clustered in those 3 sectors. And the last slide I'll show you is geographical split, which again hasn't really changed very much since we started the fund. The majority, we have a high weighting in the US. Again, I think that's sometimes misrepresented as Terry taking a big view on the US economy. We are actually big fans of the US economy, but there is no macro overlay in the funds for equity fund. It is entirely bottom up. It just happens that if you're looking for the biggest and best companies in the world in healthcare, consumer, and technology, they will be headquartered in the US. But if you look over on the right-hand side, you can see there by revenue, about a third of the underlying turnover of the companies that we own is in emerging markets, where obviously that's where the growth for consumer companies come from. North America has a much lower weighting in terms of revenue. Just before I finish, I'm going to mention one other stock, just because there was some news in the last couple of days. We own Novo Nordisk because they make insulin for diabetics. But they have fairly recently released a drug called Ozempic, which is for pre-diabetics, and it stimulates insulin production in the pancreas. But it has a side effect, which is that it is appetite suppressant. And what they did was they launched a drug called Wegovy, which is pretty much exactly the same. And this is a weight loss drug because it makes you feel less hungry. And it is selling gangbusters in the countries where it is available. There is a competing drug made by Eli Lilly called Mounjaro, which is also doing extremely well. But this is a whole new drug category of, safely losing weight, if you like, without chronic side effects. And the reason Novo's had quite a big move in the last couple of weeks, and the reason is because they've done some testing recently, which has shown that those people, particularly those sort of obese or overweight people taking the drug, that there are various cardiovascular benefits. So it is not only now known to help people lose weight, but it also improves your heart health. And that opens up a whole nother sort of line of possible growth in the future. So I just wanted to mention that because it's quite in the news. It's been written about a lot in the last few weeks. It doesn't appear on any of our slides at the moment. And so I didn't want people to think we weren't thinking about Novo, because we are. It's a fantastic opportunity, because if you think of, overweight people in the world and the number of people that would like to take a drug if they could to lose 12 to 15% of their body weight, it's an enormous market, which they are just beginning to tap into. That's it, Yoon. I'm going to stop under my time as usual. I hope you're impressed with that.
Yeah, as always, Gretel, thank you so much. Maybe just a good question from my side. We've seen with some of the other managers, or global equity managers, exposure to financials, more particular banks. I don't think I've ever seen Fundsmith holding a bank. Why never invest in banks?
We will never own a bank. And if any of your listeners, watchers, want to go to our website, there is an article that Terry published in the Financial Times in 2011 or 2012 entitled, "I Will Never Own a Bank Because I Understand Them." And that is because Terry, who runs Fundsmith, used to be a #1 rated banks analyst in the UK. Got into quite a lot of trouble, actually, because he wrote a sell note on Barclays when he was working for Barclays at the time. But the reason that we'll never own a bank is because we don't own any business that requires leverage to make a decent return. And unfortunately, banks, by definition, are heavily levered business. Every dollar that you put in your bank account, they're going to lend out 15 against your $1. And the problem with that is at some stage in the cycle, credit is withdrawn. And if it is withdrawn, it's not a long lingering death for a bank. It's sharp and very nasty. So we won't own banks or real estate or anything that requires leverage to make a decent return. We'll only own businesses that make a decent return without the requirement for any borrowing.
There's a lot about exactly what you do. Maybe a bit of a fun question from you, from the audience. If sports betting was part of Fundsmith's portfolio, where is the money to be made in the World Cup or the Women's World Cup final, Spain or the UK?
I don't. Well, I think that unlike South Africa, which is universally successful at international sport, being an English supporter of anything is deeply depressing. It's a voyage of hope over experience. See the recent Ashes series for details. So much as I will be supporting the ladies of England in the final, I would be a fool as an English person to say that I'm confident that they're going to win.
True indeed. Gretel, again, thank you so much for joining us. Always a pleasure to have you on our sessions. And we'll chat to you again very soon. And have a peaceful and great week further.
Thanks, Eugene.
Right, fantastic, thank you. Our last session for the day, definitely not the least, looking at global growth and emerging markets. And joining us from India today, Senior Portfolio Manager at Sands Capital, Neil Kansari. Good afternoon, Neil. How are you?
Good afternoon, Eugene, and everyone joining from South Africa.
Fantastic to have you with us. Neil, your slides are ready to go if you are.
Absolutely. Thanks a lot. Again, yeah, I am joining from just outside Delhi in a place called Gurgaon. So it's very pertinent that we are talking about opportunities and risks in China and India. And I'm sitting in the capital city of India. So it's interesting. I've spent the last 2 weeks here as well. So in India, so I've collected some additional insights just being on the ground. So maybe next slide. Yeah. So I think the topic is how do we think about investing in China and India? While this page says contest of the century, I want to shy away from this sort of tagline of The Economist. It's really not about a contest, but for us, it is about positioning. How should we think about positioning our portfolio in two of the largest EM economies in the world, China and India, both having about 1.4 billion-ish people. That's big economies, one growing faster than the other, India. But really the whole conversation today, my talk will be around how we should think from a very principles-based approach, how we should think about the investment opportunities within these two countries. And our bias and our research shows that India has significantly more potential over the next 10, 20, 30 years relative to China. The last 20-year returns also India has outperformed, and I'll speak about that in a bit. But really, the point is, why are we excited to be more overweight India? 31% of our portfolio, the emerging markets growth portfolio, is in India versus the benchmark at around 14.6%. We have the China the China exposure is around 16.8%. So let's say 17%. The benchmark's around 30%. So we're significantly overweight India, significantly underweight China. And I want to talk to you about the reasons why next. So when we think about investing in any company, we do pay attention to the macroeconomic environment and the macro principles behind each of the countries we invest in. We are not macroeconomic. No, just keep it on the prior slide, please, Eugene. We're not macro investors. We're not top-down investors. We are very much bottom-up fundamental business investors. We own excellent companies that grow their revenues and earnings and profits over time, great competitive moats, all the things, I think Fundsmith spoke about. We also believe in many of the same principles, but also we do pay attention to the architecture of an economy because certain economies are more favorable to wealth creation than others. So we look through the lens of these four sort of buckets when we think of any major economy. One is, of course, sustainable economic growth. We're thinking about what are the underlying secular demand drivers in that economy. These are things like consumption and the consumer, is it increasing? Is the base increasing? Is the spending power increasing? The demographics, is it a young population that's getting into the working age cycle? What is the business formation, small business, medium, large businesses? What is that formation looking like? Is the job creation happening on the ground? So these are all the sustainable demand drivers that then drives business opportunities for the types of companies we invest in. We also look for what's happening on the supply side. Is there infrastructure investments being made, fixed asset investments, digital investments? Nothing today really works without the digital architecture. Is that happening on the ground as well? For each of the countries we invest in, we're looking for financial strength, which means really healthy. It's almost like thinking like a company. Is the balance sheet of the country healthy? The debt levels, not just at the top-down reported numbers, but underlying. There's a lot of hidden debt often in countries. You kind of have to think about that because that impacts growth. The banking system, how stable that is, the fiscal and current account deficits, because those can impact currency. So we think about all those elements: stable cash flows of the country, the tax collection, etc. We're thinking about the financial strength of a country, which also again needs to be on the favorable side for you to have good outcomes by owning great businesses. The nature of competition, this is a point that I think is not very well understood, but certain countries really are favorably set up in this case, and in certain ones are not. In certain areas, we want to see who's providing the capital. Is it a free market system where business groups or venture capitalists, private equity, is that the provider of capital, or is it state? Because those two can have very different outcomes when it comes to competition and competitive landscape. How is it looking in terms of the market structure when you look down in each of the segments of an economy? For example, in India, you look at a consumer space, you'll often find 2 or 3 companies, and one of them may have 50% plus market share, and then 2 or 3 kind of dominate the market. And that happens in an economy that's fairly free market in nature. Governance, of course, drives a lot of things. Valuation drives actually growth eventually, etc. You're looking for, is it a democratic system? Is it autocratic? Are decisions being made bottom up? You're looking for legal systems. Do they work? Is there fairness in the legal system? May not be perfect. Nothing in emerging markets perfect, but is it actually functioning? You're looking for peaceful transfer of power. This is obviously true for democratic countries. Asset ownerships, private ownership. How does those assets get transferred over when legal rights change? So all of those things are very, very important for value creation for businesses actually. Eventually, culture and citizenry, of course, you want good basics on those. I won't elaborate too much on that. Next. So now this page really talks about the same points, but with the lens of India and China, because that's the topic today. You'll see in India's case, you see a lot of green arrows. These are positive in India's favor. You see some yellow or orange sort of lines. Those are neutral. You see a couple of those with China, and then see a number of red arrows pointing downwards for China. And the reason is why we favor India relative to China. And our exposure, as I mentioned, 31% in India versus about 17% in China, reflects what's happening on this page. Of course, we find great businesses in both those locations, but all things equal, this definitely helps India. Secular demand drivers, lots of demographic dividend, young population, a lot of consumer activity on the ground, and just growing leaps and bounds. Supply side investment, China did that. It's done a lot of it in the past, but on a go-forward basis, India is really going through that investment cycle, fixed asset, digital infrastructure, balance sheet as well. In China, we know there's a lot of debt issues, while not at the headline level, underneath in the banking system, in the shadow banking system, in the real estate sector. There's a lot of leverage that's in China. So there's some stresses in the system in China. India, on the other hand, the banking system is really now very, very robust. It's functioning very well. We own a number of companies in the financial sector. There are some of our actually bigger positions within the India portfolio, versus in China, we don't own any banks, for example. Nature of competition, I alluded to this a little bit, but in India, you find really oligopolistic structures where a handful of companies can really become pretty dominant. Leader takes most kind of situations. You look at the paints business, Asian Paints, which we own, 50% plus market share. The next 2-3 competitors make up most of the market. Britannia Industries, the leading biscuits company in India, 50% plus market share. The next couple of companies form the majority, and then there's a long tail. So really, you have this opportunity where the really good business is able to really take a lot of share, and in a giant market like India, it creates tremendous value. The other point around capital formation and how companies can generate very, very high returns, and you see that Indian companies generate very high returns on equity, very high returns on invested capital relative to China, and that's because of the nature of competition. Often in China, an entrepreneur comes up with a great idea, puts up a business on the ground, creates a really good business, but then every province, every state kind of wants its own champion, and capital is cheap, and they invest in all these unprofitable companies, the state or these quasi-state entities, and they destroy the return profile of businesses, which doesn't again happen in India. The state is not involved in business. it's a free market economy. So we see that again as a fundamental reason why India kind of ends up outperforming China, and I'll share some numbers. Yeah, so that's the India-China relative way of thinking for us. It's next page, please. You'll see that in the earnings growth trajectory as well. This backdrop creates much faster and secular compounding of earnings growth in India. This is just at the MSCI India level for the market. You'll see that India has been on an upward trajectory. It has its ups and downs, of course, has its own cycles, but by and large, over the last 2 decades, you've seen this upward trajectory, and it's actually accelerating. And we think the next 10, 15, 20 years could be even bigger than what it has been in the past for a variety of reasons. China, on the other hand, is more or less flat to stagnant, has been declining recently for a lot of reasons, and we don't see this gap really closing. We see this gap actually widening between India and China. Next. And investors are starting to recognize this. We've been overweight India in our emerging markets portfolio since inception, the end of 2012, beginning of 2013. So for the last decade, we've been overweight India relative to the benchmark. But many investors starting to catch on to this, and now which reflects in the next 12-month forward PE has been re-rating for India, while for China it's either flattish to stagnant, and may even show. And obviously in the last a few years it's been re-rating downwards. And again, we think India deserves a premium for the reasons I outlined. When I look at the returns, just to put some numbers behind all of this, when I look at the 20-year returns in local currency, which takes out the noise of currency appreciation or depreciation, India, the market returns, MSCI India returns over the last 20-year period has been about 17.4748%. The same time frame, China has returned 520%. So it's a 3.3x. This is just in local currency, so it's not exactly fair, but still gives you the relative compounding and the value creation that can happen in India. Of course, if you normalize in US dollars, India has seen a much more weakening currency trend, which we think is changing. India, we expect currency to be much more stable in the next 10 years for a whole host of reasons: size, scale, FDI investments coming in, etc. India in US dollar terms over the same 20 years has delivered a cumulative return of 937%, China 514%, and MSCI EM, the entire broad benchmark, of 415%. So India, even in US dollar terms, has outperformed China handedly by it's 1.8x China and 2.2x EM returns. So next page. This is a snapshot of our India positions and our China positions. As I was mentioning, we own 11 companies in India, 31% exposure, benchmarks 14.6%. It's a nice mix of companies from a few select financials like Bajaj Finance, a leading consumer lending franchise, HDFC Bank, a leading private sector bank. We own a life insurance company with ICICI, a number of interesting leading consumer businesses like Britannia, which I mentioned, the leading biscuits company, Asian Paints, the leading paints company, Titan, the leading jewelry retailer, Apollo Hospitals in healthcare, which is a leading hospital operator growing very nicely. It's also the leading pharmacy chain in the country. And then a couple of other names like Reliance and TCS, Reliance Energy plus retail plus telecom, and then Tata is a leading IT services company. China, on the other hand, is a slightly different kind of mix. Some more global opportunities emerging from China, like Wuxi Biologics and Life Sciences, Tiger Med, which is a mix of domestic and some overseas business, some big tech like Alibaba and Tencent, some consumer companies like Anta, which is basically the leading footwear and athletic apparel company, competes with the like of Nike and Adidas. Within China, a CATL leading battery maker, Anta, Foshan, Haiti, and Haidilao, 3 consumer businesses. Foshan is a soy sauce maker, and Haidilao is a hot pot chain operator. So more or less, that's the portfolio. 9 businesses in China, about 17% in China versus the benchmark at 30%. Underweight China, overweight India, for the reasons I mentioned in the last 10, 12 minutes. That's all. Open for questions. Thanks.
Neil, thank you very much. Just quickly looking at your 2 funds, you've got the Sands Capital EM fund, and I mean, the fund's exactly what the label says. You've showed the holdings here, but a lot of us are grappling with the exposure to EM markets directly. Yes, we know in a lot of developed markets, a lot of companies' earnings comes from emerging markets, but when it comes to direct emerging market exposure, different story. So maybe if you can give us some insight in your global growth fund, where the benchmark is the MSCI All Country, what is your direct EM exposure in that fund?
More
or less.
Yeah, more or less. I think it should be about 15-20% max. I'm not the PM on global growth, so I don't have the. I manage the emerging markets fund, but it generally has ranged between 15 to 25%. The global growth portfolio, but the global growth fund has no exposure to China, so most of the exposure is in India and few other markets.
So remain overweight in India. Very insightful indeed. Neil, from our side, again, thank you so much for logging into our session. We are really grateful for your time, and we'll chat through your fund or to you and your team again very soon. Thank you so much for joining.
Thanks a lot. Hope it was valuable. Thanks. Bye.
Absolutely. Yeah, audience out there, thank you so much again for joining our session today. And really all your support that you've been giving us through the years, especially the past 2 years, we remain very grateful. And a really big thank you to our speakers of today for making for an outstanding session and really a lot of food for thought. To the BCI team, Tanya, thank you so much for making for great content, as always, in organizing your sessions. Olga, for driving these sessions for us and making sure that they are flawless and running smoothly. And just a quick reminder, we are back next week, Wednesday, again, the 23rd of August, back to the normal time, 8:30, with North Star Asset Management, continuing on global. And really, thank you so much for attending your session. We will circulate the presentation and the recordings through to you all afterwards. And if there's anything else, the contact details of the BCI sales team will be on that as well. If you need any more information on any of the funds that we looked at today, and yes, they are all available in feeder funds in the BCI stable, let us know, and we'll get that info through to you or get you in touch with the managers. Until I see you again next week, Wednesday, have a super week further, and we'll chat shortly.